The whole narrative right now is focused on tariffs.
In the trade data, you've had this massive volatility.
An outcome could take as long as 18 months or longer.
For the most part, these tariffs are here. They're here to stay.
Unless it really re-escalates in a negative fashion, I don't think the trade issue is even going to be enough to kind of take the momentum out of this market right now.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Wednesday, the US and China reach a compromise.
We have reached a framework to implement the Geneva Consensus and the call between the two presidents.
The world's two largest economies striking an agreement, wrapping up talks in London just as an appeals court leaves President Trump's reciprocal tariffs in play for longer. Investors are looking for early signs of pass-through in today's inflation data. That drops at 8:30 Eastern Time. We begin this hour in the British capital. Bloomberg's Annmarie stand by with more. Annmarie, good morning to you. It wraps up late last evening. What happened and what can we look forward to in the weeks and months to come?
Good morning, Jonathan. That's right. We all left Lancaster House after midnight. 20 hours, more than 20 hours of talks between the U.S. and Chinese delegations over the course of 2 days in London. At one point, the Treasury Secretary actually had to leave because this morning he is going to be on Capitol Hill testifying in front of the House Ways and Means Committee. Basically, what they came out with was what they agreed upon, Jonathan, 4 weeks ago in Geneva, in Switzerland. But the Commerce Secretary, Howard Lutnick, telling me and a group of reporters yesterday that now they have a framework to implement what they agreed upon 4 weeks ago. He said they had to get negativity out. It felt like he said that they weren't able to actually implement what they agreed upon. There would seem to be some misunderstandings. And now they say they're going to go back to their presidents, obviously. These three cabinet officials will speak to President Trump, and then the Chinese will go back to Xi Jinping, and then they will start to implement it. It comes down to what we've been talking about the past 48 hours, and this was clear when the Commerce Secretary said, we absolutely expect that the topic of rare earth minerals and magnets will be resolved. He said there were a number of measures, those export controls the United States also put on place, and when they approve the licenses, then you should expect that our export implementation will come down as well. That's the crux of this agreement. With the United States is going to get more rare earths, and in return, Beijing is going to get an easing of those export controls.
These talks are going to take time. We talked about this yesterday. 18 months to achieve a phase one deal in the president's first term. And what we're hearing from the EU side, our reporting here at Bloomberg this morning, is that the EU sees talks extending beyond July 9th. How much time do these talks actually need?
Jonathan, these deals are going to be done in months and years and not in days. Last week, I was in Switzerland, spoke to the top trade negotiator in Switzerland, and they already have somewhat of a framework in place between Switzerland and the United States. And she said she was given assurances by Secretary Bessent and Ambassador Greer that if they do not have an agreement by July 9th, there will be an extension. How many countries are going to need an extension? I asked Jameson Greer last night and Howard Lutnick, when it comes to other countries, where are you right now? You just spent 2 full days in London talking about two key issues just with China. And they said, we're here just to talk about China. So you could see how difficult these agreements are to get over the finish line. And we remind our audience time and time again, during the first Trump administration, this was a purchasing agreement. It took 18 months. The trade war with China started 2018, and we didn't get an agreement until 2020. And yesterday, we were just talking about two key critical issues. When we started bringing up to Howard Lutnick and Jameson Greer some of the other issues, they said there'll be larger conversations. And they see that momentum as well from Beijing. But those larger conversations are going to take months. So you can expect this to be a long road ahead when it comes to trade and tariffs.
Annmarie, thank you in London. Annmarie, stay close. If we get some more headlines, we'll bring them to you. Equity futures this morning so far on the S&P 500, negative by about 0.2%. Let's get you the view on Wall Street this morning. The team over at Federated Hermes are with this to say. With the wall of worry crumbling, investors who realise they missed their chance to buy lower will likely jump into any and all dips ahead. Steve Chiavarone of Federated joins us now for more. Steve, good morning.
Good morning.
Good to see you.
How are you, John?
You've got a constructive view on this economy. Let's talk about that. I think we can all agree the worst of the policy volatility is behind us. Is the worst of the data still in front of us? That's the ongoing debate around this table.
I think expectations on the data are pretty low, right? You look at what the market consensus is. It's that inflation is going to somehow, rebound to 3.5%, and there's a predetermined 10-year yield that has to have a 5 number on it. And part of this idea of a grind, part of this idea of people getting sucked back into the market is that, we think inflation doesn't surge higher, that it continues to grind a little bit lower, that rates stabilize, that that economic data holds up and actually reaccelerates in the back of the year. And I think, the discussion on trade is a perfect example of that, right? Yeah, it's going to take weeks and months to get to resolution on what the final trade deal will be. That matters a lot for the economy. Certainly it matters for politics a ton. For the market, though, it's the fact that you've got continued progress, that you're continuing to negotiate, that you're moving towards something positive. The market discounts that and moves higher.
We've seen a massive rally over the last few months. Off the April 8th low, we've had a move of more than 20%. And yet I keep hearing that the pain trade is still higher.
Yeah.
I've seen that this morning from Max Kettner of HSBC. Dubravko over at JPMorgan said the same thing. Barclays is saying the same thing. Key pain trade, higher equities. Can it be the pain trade if everyone thinks it's going to be the pain trade?
Well, I also think I would add to that higher bond prices, lower yields, because I don't think anybody's thinking along those lines. But look, I think what you have is you have the psychological precursors to that, right? You had a group of folks that missed, that they got overly bearish in April. They missed the rally. They want to believe that rally was false hope. And then they're waiting. And they're waiting for all of those things that could go negative, CPI, rates, the big, beautiful bill falling apart. And as those bricks in the wall of worry crumble one by one, then they'll start to want to come back, but they'll say, well, I'm going to wait for a 10% pullback. And then it'll only ever be 7 or 8%. We've seen this movie time and time again. It's the dangerous element of being overly bearish in an equity market, which is, a dollar not gained is just as bad, if not worse, than a dollar lost. And I think you're going to see that reality settle in.
There's always a reason to worry. Another reason a little bit later this morning, 8:30 Eastern Time, US CPI. Mike McKee is jumping into the studio to catch up with us on that story. Mike McKee, what can we look for a little bit later this morning?
Well, John, you're talking about progress. You're talking about the U.S. negotiating a couple of points with China. People forget that the tariffs are already in place. There are tariffs out there. And what we're looking for is evidence of that in the CPI today. There's a good chance that we're going to see goods prices rising over the month. The question is how much. Most analysts think that the real numbers are going to hit, and real tariff impacts are going to hit over the next 2 months, but we're still going to get some evidence of it from May. Furnishings, electronics, apparel, things that we import from Asia are expected to be higher in price. Food at home, egg prices have gone down, but everything else has pretty much gone up. And then, of course, the president did put tariffs on used and new cars. The total impact not going to hit this month, but we are going to see some sort of effect. And that's going to push the year-over-year core and headline CPI higher. And that's going to perhaps have some limited impact on Wall Street since people are expecting it. But if we get a big move up, then, of course, you're going to have a lot of people more scared.
Mike, the Federal Reserve, how scared are they going to be? They meet a week today. And when they meet, they've got to put out new forecasts. How important is the pass-through for them?
Well, it's going to affect their forecasts in terms of how soon they think they will get to a higher level. Most of them have suggested they think we'll get to 4.5%, get to 3% by the end of the year, 4.5% by the end of the tariffs. Maybe that's the case. But it's a question of how fast you get there is what would spur them to action. If we have a gradual rise, they may feel they're tight enough right now. But if things start going up quickly, they may feel the need to move higher. Not on the card table right now, but it's out there.
Mike McKee, thank you, sir. More from Mike later in the programme. Steve, let's talk about this. 8:30 Eastern Time, CPI drops. Is it too early to expect pass-through from the tariffs already announced?
I think it is. I also think you've got to look at things like we had an ISM service number that was a little bit weak last week. And I think that's what gets missed here. Yes, certainly the price of a good that has a tariff, slapped on it moves higher. But if you're not putting more money in the consumer's hand, which so far we have not, that allows less dollars to be spent on other things. And I think what, at least in our view, is what you see is tariffs can certainly slow growth some. We're not big believers that they're in any way kind of inflationary in a durable sense.
Let's build on that. 2025 is clearly not 2022. Yeah. 2022, consumers were in a different place. Corporations would have passed these costs on almost immediately, and the labour market was a whole lot tighter. How important are those differences now when we think about the pass-through and the potential for inflation further out along the road?
Well, you also had massive fiscal stimulus, right? I mean, at the same time, and you had massive monetary policy stimulus at the same time. So, supply chain issues in and of themselves, okay, they can cause short-term price disruptions, but it really, in our view, was the fact that we injected $7 or $8 trillion into the economy that, led to that inflation. And you don't have that now. You have a labor market that's fine, but a little bit slower. You've got wage gains that have kind of moderated some. I think if the concern around where inflation is going is much greater than what we've seen in the data so far. And even with today's number, I think it's very interesting. You've got the consensus looking at, I think, a 0.3% month-over-month gain. You've got the core going up to 2.9. That's not in the Cleveland Fed's nowcast. So I think that there could be the ingredients here for another slightly softer than expected inflation report.
Is the absence of demand-side stimulus, is it a problem for this equity market?
I don't think it's a problem, but I think one of the issues that's out there is, and it's interesting, the market's almost of two minds on this. There's all of this pearl clutching about kind of big, beautiful bill and what that means for the deficit. But when we look at it, when you take the net stimulus of that bill and you net it against the tariffs, what we get to is something that's actually a little bit of deficit reduction over the next 10 years. You can actually get that with a little bit of a growth assumption into a kind of deficit reduction, only very modest stimulus. And so, to me, as I look at this economy and I look at the risks to inflation and growth, I'm far more concerned about potential risks to growth. A slowing labor market, a consumer that's showing some signs of exhaustion. I'm much less worried about inflation. I wish the Federal Reserve was in the same place, but they're not yet.
We'll talk more about the Fed in just a moment. Steve's going to be sticking with us through the hour. Steve Chiavarone there of Federated Hermes. Looking at the bond market as well this morning. Yields are just a little bit higher, up 2 basis points, 449, going into some important auctions later. $39 billion of 10-year notes coming to market later on this afternoon. Tomorrow, $22 billion of 30-year bonds. Before we talk about that, let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Anand. Hey, Yahara.
Hi, John. We start with the day's top story. After 2 days of high-stakes trade talks in London, the U.S. and China have established a deal to maintain their previous trade truce. The plan includes China's pledge to speed up shipments of rare earth metals and the U.S. easing some of its export controls. Now it awaits approval from President Donald Trump and Chinese President Xi Jinping. Meanwhile, here Los Angeles imposed a curfew in parts of downtown from 8 p.m. to 6 a.m. This coming as protests continue over immigration raids in the city. President Trump authorized the deployment of National Guard troops and active duty Marines. California Governor Gavin Newsom responded by accusing Trump of abusing his power. And the former First Buddy is feeling some remorse. Tesla CEO Elon Musk saying he regrets some of the things he posted about President Trump last week, saying, quote, "They went too far." And though it's not a full reconciliation between the pair, Musk's self-reproach is giving Tesla shares a boost in the pre-market. They are up 2%. That's your Bloomberg Brief. John?
Yahara, thank you. More on that story in just a moment. Up next on the program, a new contender emerges.
Are you already thinking about your next venture? I know it's 2026 with his service, so you're already thinking about it.
Oh, yeah, sure. It's coming out very soon.
What were you thinking about?
I could tell you, but
what do you make?
I have a pretty good idea about it.
Coming up on the program, we'll catch up with Andrew Bishop of Signum on the search for the next Fed chair, Torsten Slok of Apollo previewing US CPI, and Geoffrey Yu of BNY ahead of key US Treasury auctions. Live from New York City this morning. Good morning. Live from New York City this morning. Good morning to you all. We start with an apology from Elon Musk to the President of the United States. Out on X earlier on this morning, I regret some of my posts about President Donald Trump last week. They went too far. That apology worth something in this equity market. It's worth this rally right here. We're up 2% on Tesla. That's some single name price action for you. The broader equity market shaping up as follows, following a 3-day winning streak on the S&P 500. Slightly softer this morning. We're down 0.2% on the S&P. On the Nasdaq 100, we're down by 0.1. Under surveillance this morning, a new contender emerges.
Are you already thinking about your next venture? I know it's 2026 when his term expires, so you're already thinking about
Oh, yes, it's coming out very soon.
What were you thinking about?
I could tell you, but
what do you make?
I have a pretty good idea about it.
Here's the latest this morning. A short list of names coming together to replace Fed Chair Jay Powell. Sources telling us here at Bloomberg top names include the Treasury Secretary Scott Bessent and the former Fed official Kevin Warsh. With the latest, here's Bloomberg's Tyler Kendall. Good morning, Tyler.
Yeah, hey, John, good morning. Well, in a request for comment, Treasury Secretary Scott Bessent tells Bloomberg News that he already has the best job in Washington, but that ultimately it will be up to President Trump to decide who's best for the economy. Now, we do know that Scott Bessent does by and large have President Trump's trust as he leads some of the most consequential trade negotiations, including on China, and he has largely been seen as a soothing presence for the markets amid so much uncertainty. In fact, it was our reporting back in April that suggested it was Treasury Secretary Scott Bessent who urged President Trump to make clear he had no intentions of firing Jerome Powell before his term ends in May of 2026. Now, we should say a senior administration official did dispute the reporting without providing any sort of further specifics, and it's our understanding formal interviews have not yet started. But as you mentioned, it's clear President Trump is thinking about this. He did say on Air Force One on Friday that former Fed Governor Kevin Warsh is highly thought of. Now, of course, whoever does end up assuming the position is going to have some complicating factors to deal with here, as the White House makes clear that strategic uncertainty is something they think is a good thing when it comes to tariff policies, but of course makes the FOMC's job that much harder. And then that person is also going to have to prove that the central bank's independence will remain intact amid what has been heaping criticism from President Trump that the Fed has been too slow to cut rates. John, as you well know, President Trump did invite Jerome Powell to a face-to-face meeting at the White House last month. In a statement afterwards, the Fed said that the pair did not discuss the path of monetary policy and that Powell made clear that any decision would be based on careful, objective, and, quote, non-political analysis.
Tyler Kendall with the latest down in Washington. Tyler, thank you. So what is the challenge if the candidate comes from within the administration? Matt Lazzetti at Deutsche Bank with this to say: regardless of the choice, the market is likely to test the next Fed chair's independence and the credibility of his or her commitment to achieving the inflation target. He goes on to say a challenge that could be more serious if the candidate comes from within the administration. Steve Chiavarone, I'm sure you and the team are thinking about this, who the next Fed chair might be. What would you say if it came from within the administration?
I think it depends on the credentials, right? I mean, if you've got somebody who's a kind of solid candidate on their own merits, Kevin Warsh, I think, both Warsh and Bessent would be viewed as kind of mainstream, highly credentialed, serious candidates for that post. I think as long as that's the case, you can kind of get over that. I think what's going to be interesting about this is it looks like we're headed for a shadow Fed chair, which we really haven't had before. And so, given the Fed's reliance on forward guidance, which has become such a part of their policy tools, right? The dot plots that we all obsess over and the path of rates. If you've got, a chairman in waiting, then what does that do to the validity of the dots? Like I'm looking right now, on June 17th, 2026, there's a Fed meeting. I'm guessing we're going to cut on that Fed meeting, right? That's the first meeting after the, after the current chair's term. So I think that's what's going to be really interesting. Does the market focus on the views and policy and dots of the current Fed, or do they start to focus on the rhetoric of the shadow chair? One way or another is going to be entertaining.
So next week we get an SEP from the Federal Reserve. We're all going to be sitting at it, looking at it, going over the statement, the news conference, and the new forecasts from the Fed chair and the committee. How useful are those forecasts when we start thinking about 2026 just a little bit more?
So I don't mean this in any kind of disrespectful way. Sure. I think the Fed does great work. However, we probably pay less attention to those forecasts now than we have at any time over the last 5 years, because this is, for criticisms that are real or imagined, this is a Fed that has been more reactionary, right? To be data dependent is by its very essence to be reactionary. And so we know that this is a Fed that wants to be on hold. We know that this is a Fed that thinks inflation may come through. We're generally of the view that the risks to growth are greater and that by the second half of the year, it's going to be apparent that cuts are appropriate. And so we think a federal funds rate today that's, 4.25%, 4.5% needs to be somewhere closer to 3% over the next 18 months. And we think they're going to do that once the data pushes them there. So they can kind of write down what they want in June. That's great. You make a plan until, you get punched in the face, and we think they're going to get punched in the face in the second half and realize that they need to cut.
White House policy might punch them in the face as well.
Yeah.
The White House policy has changed a lot over the last month or so, particularly on trade. Andrew Bishop of Signum Global Advisors joins us now for more on that front. Andrew, welcome to the program, sir. Some form of agreement between the US and the Chinese late into yesterday evening over in London. What did you make of the agreement that has been made, and ultimately how much progress are we making?
So the first thing I'd say is that the way that the agreement was described, sort of this framework around a consensus, et cetera, has been pitched as a word salad, right? As sort of a bit of a nothing burger. And I think that might be a slight mischaracterization in the sense that clearly what was agreed in Geneva was not detailed enough. These are issues, when I say these, I'm referring to the export controls around rare earths and others that are quite technical in nature. And so it actually makes sense that the administration would spend several days laying out a roadmap of exactly how many rare earths, under what timeline, under what schedule, with which approvals are going to be unleashed by China and reciprocate. So I actually think that I definitely am not in the camp arguing that this is a big victory, far from, but I think it actually makes sense that they would have spent a lot of time hammering out the details.
Andrew, this is the second round of talks, first Geneva, then London. It's still early, but could you give us your early thoughts on how different these negotiations are compared to what we saw take place in the 18 months of negotiations in the president's first term to achieve a phase one deal?
Yeah, very big differences. The first difference is that neither party, and I would say especially the US side, is interested in negotiating. So it can sound counterintuitive given that we're talking about a negotiating process. But my understanding from this administration is that there is, in and around the president's orbit, a sort of level of fed-upness with negotiating with the Chinese. And there's this view that there's really no point going back and forth to Beijing, to Shanghai, or hosting the Chinese here in Washington, D.C. And so ironically, I would not expect a lot of additional trade negotiation rounds, right? So that's the first thing. The second big difference is that we're not talking about trade. We're talking about export controls. Now, you could argue that that's export controls around goods that are being traded. But what I mean is we're talking about choke points and small volumes of highly politically salient goods, not about large volumes of goods. The third biggest difference is that China really holds the cards this time. That is definitely a turning point. Ironically, China always held this sort of choke point around rare earths, but wasn't willing to use it. Now that they've shown they're willing to use it, the U.S. essentially has lost pretty much all leverage in the short term. It can regain that leverage over the medium term. But in the short term, until the U.S. sorts out this rare earth challenge, President Trump really has the lower hand, if you will.
Andrew, speaking of that leverage, right, you're dealing with a situation where the United States, outside of the UK, has chosen to prioritize China in terms of deals, right, where we may have expected deals with India or Japan or other allies. Do you expect to see more progress on deals with those allies in order to regain leverage and kind of encircle China, or do you think they're set on this course of doing China first?
No, so I definitely agree and think that the primary goal, like basically the China stuff is damage control. The primary goal is definitely negotiating with the partners and quote unquote friends and allies, including around containing China, as you mentioned. And by the way, that's one of the big reasons why the relationship with China is so fraught, which is that the administration wants to have its cake and eat it too. It wants to have China send over rare earths, but at the same time wants to continue the agenda of essentially decoupling and forcing other countries to decouple from China. That's obviously irreconcilable. I do think we're going to see a greater emphasis on the allies. Now, to be clear, our view at Signum is that July 8 is going to come around, and the president is essentially going to increase tariffs.
Andrew Bishop with the latest of Signum Global Advisors. Are you expecting the same thing? Get close to the middle of July and expect higher tariffs?
I think you might see it in isolated cases for folks that aren't playing nice, but generally I think you're going to see more deals between now and then.
Futures right now negative by 0.2%. Big morning coming up, 8:30 Eastern Time. US CPI in just a moment, a preview with Torsten Slok of Apollo. Live from New York, you're watching Bloomberg TV. 3 days of gains on the S&P 500, up over that period by close to 2%. This morning, pulling back just a little bit. We're down by close to 0.2% on the S&P. On the Nasdaq 100, down by 0.14. In the bond market, the main event later this morning, 8:30 Eastern Time. US CPI just around the corner. Your 10-year at the moment, 4.4938. Last month, when we got CPI, we closed that day at 4.4650. We've actually started to trade in a really tight, narrow trading range on a 10-year maturity over the last couple of days, if not the last month or so. So let's see what this morning brings. And then later on this afternoon, a 10-year auction. $39 billion of 10-year notes coming to market at about 1 p.m. this afternoon. So two things to watch a little bit later on in a trading session. With 3 hours until the cash open, let's get you some morning movers. Let's catch up with Yahara Arnott for more. Hey, Yahara.
Hi, John. We start with Tesla leading the Mag 7 higher. We're seeing it jump 2% here in the pre-market. The boost following Musk saying that he regrets some of the things he said about Donald Trump last week, admitting that they just went too far. He also made news on another front, announcing that Tesla's robo-taxi debut will be on June 22nd, not this Thursday, as we were reporting. So mark your calendars for that. And we switch to another automaker here, General Motors, up 0.7% in the pre-market after the company said that over the next 2 years, it'll invest $4 billion into U.S. plants. It'll use that money to boost production of its top-selling gas-powered vehicles. All of this, of course, as a way to blunt the impact from Trump's tariffs by making more of its vehicles here in the U.S. So this is a clear sign from GM that it's accepting the current environment and playing the hand that it's been dealt. And last up, we end with steel stocks. They are falling. Take a look at Cleveland-Cliffs, down more than 7%. Nucor down more than 3%. After we here at Bloomberg reported that the U.S. and Mexico are nearing a deal to ease tariffs on Mexican steel. The agreement, still being finalized, would let U.S. buyers import Mexican steel duty-free up until a certain amount. It's a shift from Trump's recent push to double tariffs on steel to 50%. But the move, of course, could pressure these steel producers. John?
Yahara, thank you. There are obvious, coherent, I think they've articulated the policy on the trade side in certain dimensions in a coherent fashion. But Steve, when I think about steel tariffs, I struggle. Maybe you can help me. Why are you putting a tariff on something to protect an industry that is so small relative to the rest of the economy when downstream producers that you want to protect and help, autos, for instance, are going to suffer?
Yeah, I think the administration views steel as a national security issue. I think if you're going to make ships and you're going to make weapons and you're going to make tanks, there's a belief you need to have some domestic production of steel. And so I think that's part of it. I think the other part of it is President Trump identifies himself with kind of that Midwestern, Appalachia steel worker. I think that's kind of his core constituency. So I think this has a little bit of a special place in his heart. I think what's most interesting about that news, though, John, is the Mexico deal. Mexico has played this round of the trade war, as well as any country. You haven't seen them in the headlines. You haven't seen the president pushing back. And I think the administration increasingly looks at Mexico as a place where you can have some of that lower value-added production that they'd like to see leave China, move to, right? Where we're not going to make sneakers in the United States, but you can make them in Mexico. So I'm very interested in seeing what that deal brings if they bring it to fruition.
Do you think that's because the Canadians operate from a place of confidence because they have USMCA on their side?
No, I also think the other thing that's at play here is this administration views the allies differently. I think in their world, India, Saudi Arabia, Mexico are maybe a little bit more strategic in terms of their long-term geopolitical objectives than Canada, Europe, and the UK were over the last 50 years. And I think you see that a little bit.
That's the latest on Mexico and a steel story. On our radar this morning, our top story, the US and China reaching a compromise after 2 days of negotiations. Officials agreeing to a framework that needs to be signed off on by President Trump and by the Chinese leader Xi Jinping. Elsewhere, the Tesla CEO Elon Musk saying he regrets some of his social media posts during his public feud with President Trump last week, saying they, quote, went too far. In the pre-market, the stock is doing quite nicely off the back of that apology. The stock is up by almost 2%. And finally, the European Union thinks US trade negotiations could extend beyond President Trump's July 9th deadline. Sources telling us here at Bloomberg, the EU says the best case scenario is an agreement is reached on the principles of a deal by the deadline. Bloomberg's Brendan Murray joins us now from Brussels with more. Brendan, I guess not unexpected. It takes a long, long time to agree a full, comprehensive trade deal. What can we expect by the early days of July?
Well, I think in terms of this European situation, that they're coming up very quickly on this July 9th deadline, and there's not a whole lot of progress to show for it yet. So what they're going to hope for, and their best case scenario, is that there's some sort of tentative short-term arrangement to say, here are the targets we're going to shoot for to keep continuing these talks. Let's postpone the 50% tariffs that President Trump has threatened to put on the European Union and keep talking at the negotiating table. We're seeing a similar kind of situation play out with the U.S. and China talks, to where they can barely, it takes a month to figure out what they agreed to in Geneva. This is what they did over the past couple days in London. Took them 20 hours to figure out how they were going to implement this, the pledges that they made a month ago in Geneva. So I think what we're seeing is these noisy trade wars turning into this slower, duller sort of slog that they often can be if you're dealing with complex, massive trading relationships that have taken decades to build up the imbalances that they've had. To try to undo those in a couple of weeks or months is looking more and more unrealistic.
And Brendan, not just negotiate these things all at the same time with different countries, but negotiate different things with different countries. What stands out about the London talks is it was primarily about export controls. When you think about Europe and the EU, what's the focus with the Europeans? How different are those conversations?
They seem to be very different in terms of the tone that the administration, the U.S. administration, is striking. The mood, the body language out of the Commerce Secretary and the U.S. Trade Representative last night when these negotiations with China broke up was a sort of we have a kind of a trust but verify sort of situation now with China. With the U.S. and Europe, it seems that there is there's a lot of room for the U.S. to try to impose these tariffs and to, as we report today, to come out with some sort of asymmetrical solution for the U.S. The Europeans are not going to take that. They have retaliatory plans in place to strike back. So that is where it seems like there's a de-escalating mood happening between the U.S. and China, at least for now, and the U.S. and Europe, we could see some escalation before we see the temperature go down in that situation.
Brendan, appreciate the update on the reporting. So that's the latest on the trade talks at the moment. Today at 8:30 Eastern Time is about how the policy bleeds into the economic data. US CPI due out at 8:30 Eastern. The estimate in our survey expecting core CPI to increase by 0.3% month over month. Torsten Slok of Apollo writing, the consensus expects inflation to rise in the US but fall in the Eurozone. Torsten joins us now for more. Torsten, let's focus on the US side of things and then we can get to a more global dimension. Let's focus on the US with the tariffs in mind. Is it too early, Torsten, to expect those tariffs to show up in the data this morning?
No, it's not. What really is the key issue here is that there is indeed going to be some upside pressure on inflation. And what's most critical about this is that it's all about the behavior among companies. How do they respond to tariffs? Do they pass on 100%? Will they pass on 50%? Or will they pass on nothing? If they pass on nothing, of course, then tariffs have to be absorbed by the E and the PE ratio, namely by earnings. So it becomes very important, the data print today and for the coming months. And we should expect to see some upside pressure on inflation coming from tariffs. But it's also the upside pressure we're watching that's coming from what's going on with the dollar. The dollar is down quite significantly since the beginning of the year. This is also beginning to creep in as a risk to the upside for inflation. And finally, the other thing that's also beginning to become a risk is that the restrictions on immigration. We saw last Friday some upward pressure on wage inflation. This is also something that's an upside risk to inflation over the coming months. So the bottom line to your question, Jonathan, is that we should expect to see from a number of different forces upside pressure on inflation for the next several months, including in the data today.
Will it be sustained beyond the next several months, Torsten? As you alluded to, as you indicated, that is the key question right now, the central question for a lot of people in financial markets. What is on your dashboard that guides that for you?
Well, my dashboard is to type ECFC go on Bloomberg and look at what the consensus is expecting. And that will tell you that CPI is expected to go up from 2.6 to 3.3 by the end of the year. So that's roughly a half a percentage point increase in inflation. And that's the same for core PCE and for headline PCE. So the issue there is that we should expect to see this take quite some time, because it all depends on the company's behavior in terms of when do they begin to implement higher prices on the back of inflation going up. And that is something that in the profile of inflation unambiguously pushes us up above 3%. And this is very important because the starting point, if we had started with inflation today at 1.5 and we had 0.5%, then we would get much closer to the Fed's target. But the problem is that the levels we're at, 2.8 of inflation today, is already at a level that is significantly above the Fed's target. So if you add a shock of lifting another 0.5 percentage point to inflation, that really complicates the Fed's job and therefore makes it very difficult for them to cut rates in an environment where there's so much upward pressure on inflation.
So Torsten, in an all other things being equal world, right, when you slap a tariff on, the price of those goods move up. I think that's clear. There are some offsets, though, potentially. I'm interested in your thoughts there. One, right, energy prices have been lower now for a kind of sustained period of time, so there's some disinflationary potential there. Also, the ISM service number last week came in below 50, and so there's some signs of slowing in the service economy. So how do you think about some of those potential offsets, and do you think they're enough to maybe stunt the impact of what you're expecting from a tariff perspective?
No, you're right. From a growth perspective, lower energy prices is certainly helpful. But core PCE and core CPI, of course, excludes food and energy. So from the Fed's perspective, they would likely focus on that there is general upward pressure in the broader measures of inflation, excluding food and energy. And to your services, it's right. NFIB has been showing some upside pressure also on the expectations to inflation. There's also some measures, of course, of inflation expectations, both from the University of Michigan and the Conference Board, that is also telling you that inflation expectations are way too high relative to where the Fed would like them to be. So you're right, there are some nuances in terms of, yes, there are different things going on in some of the, especially survey-based data of what's going on with inflation, especially when it comes to household expectations being very, very high. So combined, I would still come to the conclusion that I worry more about the upside risk. This is also what the Fed has in their own forecast. That's what the consensus is forecasting. That's also what we're forecasting. So for what it's worth, I still think that the overall risks, yes, surveys may show that ISM was a little bit weaker when it came to prices paid, but the bottom line is that the tailwinds coming from tariffs, coming from a lower dollar, coming from restrictions on immigration are just pretty strong. And that's combined with, at the same time, a slowdown in growth, partly because of tariffs, of course, also weighing on sales for companies, but also a slowdown in growth because of the new factor that's emerging, namely consumers are beginning to take a hit now because student loan payments are restarting. And people are beginning to take a hit on their credit scores if they don't pay their student loans. So the New York Fed is estimating that's as much as 6, 7, 8 million households that now are at risk of no longer being able to get credit. So that's a headwind to growth, while we at the same time have some upward push on inflation. So that's stagflation in a nutshell as the baseline scenario that we view as the most likely case at the moment.
Torsten, that final point is so important. Are consumers in a position to eat it? And is the labour market tight enough for them to demand the higher wages to fund it? What's your assessment of that situation now?
So one way to assess that is, once again, to go to your Bloomberg screen and look at the Red Book same-store retail sales. That went up a lot just immediately during the Liberation Day weeks when we had, of course, a lot of people that were front-loading their purchases. But in the last several weeks, the same-store retail sales data from Red Book has started to show a seeping lower. We're now below 5% in nominal growth for same-store retail sales. We are watching that trend very, very carefully. And this is weekly data that comes out every Tuesday at 9 a.m. That will tell us something about, is the consumer really in such great shape as their balance sheets would be saying? Or are these headwinds, especially headwinds coming from tariffs, headwinds coming across the board, especially from the student loan problems that are beginning to emerge? And they only really started emerging here in May. And we are worried that the U.S. consumer could begin to slow down. And we're beginning to see some signs of that trend downwards in the Red Book same-store retail sales data.
What you're describing is potentially a nightmare for the Federal Reserve. You talked about the dynamics playing out in Europe. The ECB has been reducing interest rates now for a number of months. Torsten, where do you think it leaves the Federal Reserve at a time when I hear a lot of people saying they should just sit this out for the summer and maybe sit this out for the rest of the year?
That's extremely important because this issue is, of course, exactly that. If you have higher inflation, the Fed should be hiking. If you have lower growth, the Fed should be cutting. So which one is it? Does the Fed like apples? Do they like oranges? How much weight do they put on inflation going up? How much weight do they put on growth slowing down? And the dual mandate is torn in two completely opposite directions. That's why the easy answer to that for the FOMC members is to say we're not doing anything. But exactly to your point, Jonathan, what if the inflation data does start to move up much more? Or on the other hand, what if growth starts slowing down more? It's a really difficult spot for the Fed to be in because monetary policy works with a lag. FOMC members will say that's as much as 12 to 18 months. So it's almost impossible for them to catch this falling knife because we just don't know at this stage whether the growth slowdown will dominate or whether the rise in inflation will be dominating.
Hey, Torsten, provocative stuff. Appreciate the catch up. Torsten Slok there of Apollo. Throwing out that a stagflation base case, at least for him. I know you look at things slightly differently.
Yeah. So I think what was laid out there very eloquently is the consensus view in the marketplace, which is that, tariffs are both negative to growth and they're a push higher in inflation. I do think there are some offsets, though, right? I think, those lower energy prices over time then start to seep into other prices. I think at the same time, we're not going to see all of those tariffs implemented. You're only going to see some fraction of those implemented. And so, our view is that represents that wall of worry that we're talking about. I'd also say, John, on the Fed, there's an old adage, if you're approaching a stoplight and it's going from green to yellow, the right thing to do is stop. The wrong thing to do is run it. The worst thing to do is stop in the middle of the intersection. And while I do get that there are pressures on both sides of the dual mandate, I think the Fed needs to choose. Are they going to run the light or are they going to stop? We're generally of the belief, again, that the risks to growth outweigh the risks to inflation. I think you're going to see that become apparent over the next several inflation readings, this summer.
We get one more later on this morning, 8:30 Eastern Time for US CPI. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Let's catch up with Yahara for more. Hey, Yahara.
Hi, John. A legal victory for the president on the trade front. A court has ruled that Trump can continue to enforce his global tariffs. The U.S. Court of Appeals for the Federal Circuit extended an earlier reprieve for the administration, which is challenging a lower court ruling that blocked the tariffs. Arguments are scheduled for July 31st. Meanwhile, SpaceX called off a mission that was supposed to take off this morning. 4 private astronauts were scheduled for liftoff to the International Space Station with NASA and Axiom Space. But the launch was delayed to fix a liquid oxygen leak that was found during inspections of the rocket. SpaceX says a new launch date will be announced once the repairs are complete. And PIMCO saying they are cautious on private credit. In a new report, the firm warning that current stresses could worsen sharply in a recession. But Fortress Investments has a very different take. Co-CEO Josh Pack speaking to Lisa, our own Lisa Abramowicz in LA.
There's a large trend towards kind of private credit taking market share away from the commercial banking system. And we've seen that in a number of different products, whether that's real estate, private credit, forward flows, consumer finance. And it's we think it's a terrific opportunity. We think it's kind of a long-lived opportunity.
Coming up at 2 p.m. this afternoon, Lisa will be sitting down with DoubleLine CEO Jeff Gundlach at the Bloomberg Credit Forum. That's your Bloomberg Brief. John?
Don't miss it. Yahara, thank you. A must-watch conversation coming up a little bit later on this afternoon. Up next on the program, losing confidence in U.S. debt.
Foreign investors presumably are moving out of the longer end of the U.S. curve and going into the safer zone in the shorter end. I think in part because they've lost some confidence in the dollar, in part because they've lost some confidence in the ability of the U.S. to manage its deficit.
That conversation up next with Geoffrey Yu of BNY from New York City. You're watching Bloomberg TV. The bond market in focus this morning. Treasury yields look like this. Yields higher by 3 basis points, close to 450. Later on, 8:30 CPI. Later on this afternoon, we get some debt supply. Under surveillance this morning, losing confidence in U.S. debt.
Foreign investors presumably are moving out of the longer end of the U.S. curve and going into the safer zone in the shorter end. I think in part because they've lost some confidence in the dollar, in part because they've lost some confidence in the ability of the U.S. to manage its deficit. We may have to see higher yields to equilibrate demand and supply. A lot of narratives, a lot of trends out there that are inflationary and tend to move people away from a willingness to buy nominal assets.
So here's the latest this morning. $61 billion in Treasury notes up for auction between today and tomorrow. That will gauge appetite for US debt. Joining us now to discuss is Geoffrey Yu of BNY. Jeff, welcome back to the programme, sir. Let's just talk about this from an international perspective. How is this supply being viewed by investors beyond the shores of this country?
Well, I would say it's being talked about a bit more than being acted upon. If we look at our flow data of late, if we look at the plus 10-year part of the curve, external demand has actually been pretty good, I would say. Around Liberation Day, there was also interest in that. And we think that rather than talk about the Treasury side of things, the actual release valve has been in the dollar. So for an international investor, seeing a 30-year at close to 5% with euro-dollar at 115 probably offers more value than the 30-year at, let's say, 150 basis points lower and euro-dollar at parity. So I think that's the dynamic right now.
Jeff, do you think sentiment around Treasury has exceeded kind of the reality? I mean, there's been a lot of negative talk about kind of demand for Treasuries, but if I'm looking on a kind of 3-year basis at, 4.5%, we're kind of in the middle of where the 10-year yield has traded. So what's your perception of kind of negative sentiment versus the reality and how the Treasury is trading?
I would certainly agree with that in terms of looking at our flows again. So yes, there was some liquidation around half the second half of April in the parts of the curve. I'd hazard to ask that foreign investors tend to own in the more liquid parts, but they actually have come back. So looking at the long end, duration interest is there, and now I actually ponder if duration interest is signalling some concern about growth, not just in the US but globally. So that sense of using the Treasury market as a proxy for safety, notwithstanding the current noise right now, that still very much is in place based on our flow data.
Jeff, we certainly had a lot of conversations about a repricing of US growth from 2% down to something closer to 1%. Have you had the same conversations in the Eurozone yet? And do you see that appropriately priced in financial assets there?
Well, I think from the Eurozone, they're in two minds right now. So, do you worry about, in terms of the drivers for growth, you still have the long-term demographics. How about the productivity side of things? Can US maintain that? Maybe some discussions there. But from the Eurozone's point of view, looking at, some areas of stock markets, for example, in the industrial and defence side, is the market actually a bit over-expectant on European trend growth? We're pricing 1.5 close to 2. That's where I think Europe should worry a bit as well. Where's the execution of the fiscal plans?
This would introduce the ultimate pain trade for me, Jeff. A lot of people are talking about the pain trade being a higher equity market and maybe lower bond yields. Steve was talking about that earlier. What about a stronger dollar? I can't think of many people out there that believe we'll see a stronger dollar into year-end. Euro-dollar right now close to 115, and I'm hearing people talk about the 120s just around the corner. Would you push back against some of the dollar bearishness of the past few months?
Yes, and in the same way that I have been over the last 18 months, I would say, in terms of 110, 120 range, I'd be closer to 110 towards year-end. I think two main reasons. One, ECB would push back against it. If we're not going to the last meeting, but the meeting before that, Madame Lagarde, many members, they were very, very vocal on euro starting to restrain financial conditions. And secondly, if we talk about dollar valuations, should the dollar weaken over time? Yes, but maybe it's dollar versus APAC, dollar versus some EM names on a basket basis. That's where the release valve needs to be rather than euro-dollar itself. So we're probably talking about the wrong proxy here for ultimate dollar valuations.
Jeff Yu of BNY. Jeff, appreciate the update. Thank you, sir. Steve, just a final word. Is that a trade you like as well?
Yeah,
maybe a stronger dollar.
This is a happy one. I couldn't agree with Jeff more. I think that the ultimate pain trade right now is actually yields that come down. And I think a dollar that strengthens in the middle of the year, particularly when you pass BBB.
Steve? Enjoyed this. It's good to see you.
Great hour, John.
The hour has whizzed by. Steve Chiavarone there of Federated. Up next, Dan Skelly of Morgan Stanley, Ed Mills of Raymond James, Bob Diamond of Atlas Merchant Capital, and Mike Schumacher of Wells Fargo as we count you down to inflation data later this morning.
The whole narrative right now is focused on tariffs.
In the trade data, you've had this massive volatility.
An outcome could take as long as 18 months or longer.
For the most part, these tariffs are here. They're here to stay.
Unless it really re-escalates in a negative fashion, I don't think the trade issue is even going to be enough to kind of take the momentum out of this market right now.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. The second hour of Bloomberg Surveillance starts right now, and your price action looks like this. Following 3 days of gains on the S&P 500, negative by close to 0.2% on the S&P. On the Nasdaq, we're down by a similar amount. In the bond market, the focus for a lot of you later on this morning and this afternoon, 10-year yields a bit higher, up by 3 basis points, close to 450 on 10s at 449.77. Going into this, your day ahead shaping up as follows: 8:30 Eastern time, so 90 minutes from now, US CPI. Then later on this afternoon, a dead auction of 10-year notes. Tomorrow, 30-year bonds. All of that still to come through the next 24 hours. We begin this hour with our top story. The US and China reaching a compromise.
We have reached a framework to implement the Geneva Consensus and the call between the two presidents. We had to get sort of the negativity out, and now we can go forward to try to do positive trade, growing trade, and beneficial to both China and to the United States of America.
Tracking these negotiations in London, Bloomberg's Annmarie. Annmarie, good morning. Give us the update, just how much progress we've made over the previous 48 hours.
Well, the progress they made, Jonathan, is basically going back to what they agreed upon 4 weeks ago in Geneva. But as Andrew Bishop of Signum told you in the last hour, he thinks this is more than just what some people are saying is word salad when it comes to this Geneva Consensus and this framework, which, by the way, we don't have written yet and haven't been able to read. He says this is about a little bit more of technical details. And officials had told me that. They were trying to work out technical details because what they are dealing with is technical materials when it comes to rare earth, these micro metals that are used in the U.S. defense sector, in the mobile phone industry, in the technology sector, and also when it comes to export controls. This is something China wants to see. And the key quote last night from Secretary Howard Lutnick when he was briefing me and other members of the press, he said, "We do absolutely expect that the topic of rare earth minerals and magnets will be resolved when they're able to implement this framework." He went on to say there were a number of measures. Remember those export controls since Geneva the U.S. put on, things like jet engine parts, nuclear materials. He said that if the rare earths were not coming, then those will not come off. But you should expect those to come off, sort of as President Trump said, in a balanced way. So when China starts approving those licenses, when it comes to the rare earth and magnets, then potentially those export controls will be eased. The key question here is how far is the U.S. willing to go? When you say the export controls are for national security reasons, how do you then politically go back and say, actually, we need to ease them because we're not getting the rare earths? This is a huge piece of leverage Beijing has right now.
So, Annmarie, that's only one part of the conversation, export controls. Then we need to talk about tariffs more broadly. And then we need to talk about purchase agreements, which dominated the first round of talks in the president's first term. What's happened to all of that stuff? Because as far as we're aware from the outside looking in, it was barely discussed.
That's exactly right. And I asked USTR Ambassador Jamieson Greer about this, and he said, yeah, this will be part of a broader conversation when it comes to Beijing. But clearly, they can't have that conversation if they can't agree on these two sticking points, which, as Andrew Bishop and a number of individuals have said on our program, like Ed Mills, these are the choke points. And they cannot have that broader conversation until they get to an agreement on these two choke points for both of these economies, which begs the question, Jonathan. Those tariff rates in Geneva, that was the big win, right? Bringing those tariff rates, basically an embargo for trade on these two economies down to levels, 30% and 10% in respect to both of these economies, China and the United States. Well, that's only till mid-August. What happens if we keep seeing this escalation to de-escalate by mid-August? Are tariff rates going to go back up? And this is only one economy the United States is dealing with right now. They are still in ongoing negotiations with Switzerland, the European Union, Mexico, Canada, South Korea, Japan, and the list goes on. Remember, for those countries, the deadline is much sooner. That's on July 9th.
And before you go, let's take a beat on the Europeans. What deadline? They believe this is going well beyond July 9th.
A lot of countries think it's going to go well beyond July 9th. They think that if they at least get into an agreement of principle, and potentially a meeting of the minds between Brussels and Washington, or Bern and Washington, or Tokyo and Washington, that they can get an extension of these negotiations. Because remember, trade deals are done in months and years, not days and weeks. And that is going to be very challenging when it comes to the timeline. Because remember, this administration continuously talks about an economic program that is a three-legged stool. And to have that tariff revenue, they need that to then also politically pass their one big, beautiful bill that is being debated in Congress. And all this looks, Jonathan, like it's going to drag well into the fourth quarter and potentially into the start of next year.
It's going to be a long summer, a long year, a long 12 months. Annmarie, thank you with the latest in the City of London. Here's the view here in New York on Wall Street this morning. Dan Skelly of Morgan Stanley writing, I am fully expecting the market to chop around at 25 until it has more clarity on the depth of tariff changes. But our team believes that the 5,000 level that we hit during April lows was already pricing out this bear case outcome of a lost year of EPS. Dan joins us now for more. Dan, good morning.
Morning, John.
You're going to be with us through the ads. We've got time to work through a number of issues, but let's start with this one. What are we priced for now?
I think the key insight, and I'm thinking back to when we were together last in studio on April 7th at 7 a.m., the key insight was that tariffs would be negotiated. And a lot of people weren't convinced of that at that time. It was a very uncomfortable moment. We were down 20% for the year. So we fully retraced that, as you know. And I think what's priced in right now is this hope that we're going to have some negotiations in progress with the EU and China and Japan and many of our allies. But at the same time, that the economy is just going to continue to grind through, the consumer's not going to be affected, and that earnings and multiples are going to stay pretty lofty. And I think that's a lot of really high sentiment at the moment.
Let's sit on multiples, because I remember the conversation we had in early April. In fact, yesterday I cheated. I went back over the notes. And in the notes at the time, you said that maybe the multiple of 19 to 20, which was viewed as a floor, might start being viewed as a ceiling. Now we're at 21 forward times on the S&P 500. What is it now?
John, such a great point. There's two issues to think about. Number one, we're going to have a somewhat unfunded tax bill coming through the pipes in the next couple of months. That's going to lead to even higher term premia and a weigh on multiples. Number two, only about 10% of companies during 1Q took any tariff-related impact into their guides for the year. So as we get through July, as we get through October, and we have somewhat more clarity related to tariff levels, there's going to be earnings downgrades coming. And I think the best way to think about that in context, go back to 2018, which I think not enough people are talking about, frankly, but we went from a 1.5% average tariff to a 3% tariff. It was enough to create flat earnings for 2018, 2019. So how can we go from a 3% rate today to even the best case scenario, which is still unknown, of a 12% rate and not have an earnings impact?
I'm pleased you brought up July 2018, because the conversation lasted 18 months before we ended up getting a phase one deal in the first month of 2020. And as we said on the program yesterday, that phase one deal was quickly forgotten about once we got into the pandemic. You've brought up an important point. Later on in the summer, there is a belief that the bill needs to be paid, that the data we've seen so far only reflects a front loading, and the data has been flattered by the front loading we've seen already. Is that basically what you're articulating to clients at the moment?
It is, and we would just argue that the Senate's version of the bill, which is likely to get some more steam, is maybe going to add upwards of $1 trillion more to the deficit in the coming years. And so, yes, rates have kind of stayed in this very steady level of around 4.5%, but I would argue rates are going to touch 5 before they touch 4.
Okay, deficit spending has not been bad for stocks over the last 15 years.
Correct.
Why does it start becoming bad for stocks this time around?
I think it's based on a number of things, but at the same time, over those 15 years we were doing deficit spending, globalization was still working its way through the P&L of a lot of business models. You had this massive explosion in U.S. tech and growth. And so I think on two fronts. Number one, deglobalization, or slowbalization, as we're calling the new tariff paradigm, is going to be an impediment in many cases to certain P&Ls, number one. And number two, you're reaching just law of large numbers as it pertains to the concentration of Mag 7 in tech in the U.S. market. And then even more broadly, Jonathan, thinking about the U.S. market as a percent of global markets in ACWI, multi-decade highs. So law of large numbers is running up against those issues going forward.
You know what the pain trade is? The pain trade is the equity market keeps climbing higher. There's a second aspect to the pain trade. JPMorgan has communicated this in the past week, that narrow leadership continues, that tech just keeps outperforming.
Feels like it.
What's the biggest threat to tech? Where does that come from?
So I guess I would say in terms of tech, seeing maybe a delay or a slowdown in these use cases of AI adoption. And look, at the moment, that story really is playing out, I think, on the positive front. So you're seeing Mag 7 not only start to see return on investment in terms of their wild spending ride of the last several years in CapEx, but you're seeing monetization evidence in software and consumer internet. And so I think the market is willing to wait and wait for the Fortune 100 and the corporate American AI adoption cycle to play out next year. But we're going to have to start to see more evidence of that.
What are you telling clients to do right now?
Right now, we're saying that 6,000 is a level where you want to frankly trim or rebalance on the equity market. I would just argue, again, higher rates relating to the tax deal and term premiums, uncertainty still on tariffs and where they net out in terms of the earnings impact. Let's look at the China news over the last several days. The new agreement looks a lot like the old agreement of several weeks ago, so not a lot incremental there. And then just candidly, John, I would argue it's somewhat alarming that our best allies, particularly on the military front, Japan, Korea, India, weren't the first to make deals very quickly because they would have exerted the best terms and the best leverage for themselves. So that's, I think, a little bit worrisome.
Rebalance out of what and into what? Are you rebalancing out at equities at the index level, market cap weight, specific sectors? Into what after that?
Mostly at the market cap weighted level. And we're telling folks that the downside is not draconian. It's really not another bear market. It's probably 5 to 10% over the summer. And look, we've seen this movie how many times, John, over the most recent couple of years with summer liquidity and seasonality. We saw it last August with the yen carry unwind as an example. That was a 9% drawdown in 12 days. So I would just argue over the next 3 to 4 months, this is a time to take a little bit of money off the table at the market cap level.
Futures right now negative by 0.2%. Dan Skelly of Morgan Stanley will be sticking with us through the next 50 minutes or so. Let's give an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Yahara Anand. Hey, Yahara.
Hi, John. The EU sees trade negotiations with the U.S. extending beyond President Trump's July 9th deadline. Sources telling us here at Bloomberg the EU thinks the best case scenario is it reaches a deal in principle by the 9th, which would allow further talks to work out the details. The U.S. is expected to respond to the latest round of negotiations in the coming days. Meanwhile, Elon Musk is pushing back the launch date for Tesla's robotaxi network. Bloomberg previously reported it would debut in Dallas tomorrow, but Musk now plans to unveil the service on June 22nd. But noted the date could shift again due to safety concerns. Tesla hopes to autonomously deliver a vehicle from the factory to a customer's home on June 28th, which is Musk's birthday. And NVIDIA is ramping up its AI ambitions in Europe. CEO Jensen Huang announcing a partnership with a French startup with French startup Mistral to build an AI cloud. Wang said Europe's AI computing power could grow tenfold in 2 years. NVIDIA is also expanding into quantum computing, saying the field is nearing an inflection point. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later on this hour. Up next on the program, awaiting final approval.
We have reached a framework to implement the Geneva Consensus. The idea behind all of this is for us to increase our trade with China.
Coming up this hour, Ed Mills of Raymond James with a US-China trade framework in place. We'll catch up with the former Barclays CEO, Bob Diamond, on the state of the banking sector, and Mike Schumacher of Wells Fargo counting down to CPI in just over 1 hour's time. Waking up to this post from Elon Musk a little bit earlier on this morning, saying the following out on X: I regret some of my posts about President Donald Trump last week. They went too far. Hearing from the president in the New York Post in an interview with them this morning on whether he could reconcile with Elon, I guess I could. Better news for the stock apparently in the pre-market, higher by 1.75% on that single name. For the broader equity market, let's start with the S&P 500. 1 hour, 14 minutes from now, US inflation data. Equities into that following a 3-day winning streak, down by 0.3% on the S&P. On the Nasdaq 100, we're down by 1/3 also. Under surveillance this morning, awaiting final approval.
We have reached a framework to implement the Geneva Consensus. The idea behind all of this is for us to increase our trade with China, right? We have an existing significant trade deficit, and it's been President Trump's fundamental goal is to reduce the trade deficit and increase trade.
Here's the latest this morning. The US and China have reached a preliminary truce. Both sides are now taking the proposal back to their respective leaders for final approval. Bloomberg's Tyler Kendall joins us now from Washington for more. Tyler, let's pick up on the language from the Commerce Secretary, Howard Lutnick, there, saying that the president's fundamental goal is to reduce the trade deficit and increase trade. What have they achieved in the past 24 hours that lends itself towards hitting that goal?
Yeah, hey, John. Well, really at the center of this, of course, as you well know, is trying to lift these export controls that the private sector has really sounded to the White House could impact their supply chains, including the auto industry. And we know that getting access, speeding up those export licenses when it comes to rare earths has been top of mind for President Trump. In fact, he said it was the number one thing that he spoke about on the phone with Chinese President Xi Jinping last week, as China controls 70% of the world's production when it comes to rare earths. Now, we are still waiting on what those critical details ultimately are going to look like, but it does appear that they were able to get past this impasse that really was in place in exchange for the U.S. lifting those new restrictions that they really did put into place in recent weeks as this started to escalate. And we're going to be watching closely if that does end up extending to those high-tech sectors such as jet engines or the software for AI chips, because at the end of the day, we need to keep in mind that this White House put those in place on the basis of national security concerns, and this really would be a reversal in policy. At the end of the day, though, if this ultimately ends up advancing towards what does seem to be a more lasting de-escalation, perhaps, as they continue these negotiations, then that would make good on the goal that Howard Lutnick is talking about, that they do want to keep bringing in this tariff revenue as those tariffs do remain in place, but it does perhaps allow them to negotiate towards a broader trade deal.
Tyler, just before you go, the Treasury Secretary, of course, had to make a dash for the airport yesterday evening to get back to Washington, D.C. to testify on Capitol Hill. What are we expecting to hear from the Treasury Secretary later on this morning into the afternoon?
Well, I'll be heading up there shortly. He's testifying before the House Ways and Means Committee. In principle, this is supposed to be about the Treasury Department's next fiscal year budget request, but no doubt he's going to be asked questions about these trade conversations, but also, importantly, the reconciliation package, because keep in mind the chairman of this committee is Jason Smith, who is the lead tax writer on this tax package. And we know that the House is waiting for the Senate on some pretty critical details. Now, the latest reporting is that there has been one big hurdle that has been overcome, and that comes to no taxes on tips or overtime pay. We know the Senate wanted to make some changes there, but the House made clear that was a priority for the White House, and at the moment, it doesn't seem that's going to be left out of the package.
Tyler Kendall with the latest down in Washington, D.C. from the nation's capital. Tyler, thank you. Joining us now to extend the conversation, Ed Mills of Raymond James. Ed, welcome back to the programme, sir. Let's just sit on China and the US specifically, that trade conversation. Are export controls becoming the main tool for negotiations now? And where does that leave tariffs? Is it a stretch to say that maybe the tariff story might already be done?
So export controls are hugely important, especially for the rare earths that China is restricting into the United States. We've talked about this on the show, that if we do not get access to this, our industrial capacity as a nation is going to be severely impacted. So a deal has to happen, John. What happens on the other side, how far Trump can go, I think jet engines, probably the software, maybe. Loosening restrictions on semiconductors, that's going to be a really hard sell, especially on Capitol Hill, which is moving legislation to even go harsher on some of those export restrictions. You go back to his first term, John, there was sometimes when he cut a deal with China, and then he had a huge problem on a bipartisan basis on Capitol Hill. He needs to be careful as far he's willing to go here, because if he goes too far, Congress will pass something that pushes him to a different direction and could upend all of these conversations.
I'm pleased you went to the first term, Ed, because I went over that language from the Commerce Secretary, Howard Lutnick, just moments ago. We played the clip that the president's fundamental goal is to reduce the trade deficit and increase trade. One way they agreed to do that in the first term was through purchase agreements. How far away are we from purchase agreements this time around?
Well, if you go back to that March 2020, quote unquote, phase one trade deal, China almost did none of those purchases. COVID happened. Biden was elected. And what we've heard a lot from our contacts within the Trump administration is that before they think that they can really get into a lot of these negotiations, China has to start making good on some of those commitments. And so what I would be interested to see, and especially with what the Commerce Secretary said, if we are trying to reduce that trade deficit, China has to significantly up a lot of their purchases, especially on agricultural goods. That's something that this administration would love to see happen. I'm pretty optimistic that could happen. And I keep on going back. China on Trump 2.0 is really good at identifying choke points and identifying kind of who's in the room, kind of how the Trump administration is responding to this. They are coming at Trump very differently in his second term, which to me tells us that Trump is going to have to go a little bit further than he would like trying to get this deal.
Ed, good morning. Looking back now with the benefit of hindsight, some of the tech and semiconductor restrictions that were put on in the initial Trump administration back in 2018, 2019, people are now saying that they led to China getting more innovative around creating DeepSeek. Today, you're now hearing this news around rare earths and how essential and dominant that category is for China, and the leverage is now going back into China's direction. So I'm just curious, what is the next shoe to drop in terms of the unintended consequences of these really draconian tariff approaches by the administration? Is there yet another sector or industry that's going to be revealed in China's favor?
Yeah, so I think when we look at those semiconductor restrictions, I think you're absolutely right. There's a huge debate within the investment community. I get a lot of questions here at Raymond James about this, a huge debate in Washington, D.C. Were those effective? And I think what the problem for the president right now is that if you look at certain China hawks within his administration, what they would say is they need to be much more restrictive. If they're able to do things like DeepSeek, why are we allowing them to have access to any technology whatsoever? In my perspective, that's a huge concern for this tech restrictions to go far beyond what they are right now. Does it go into some of the lagging edge technology that had been off limits? The Biden administration said small yard, tall fence. Is this a much bigger yard? As it relates to the rare earth and critical minerals, what I expect out of the Trump administration is after we get through this bill, we've already seen executive orders trying to increase production here in the United States. Could we see a CHIPS Act for rare earth? Is this going to be a critical part of a lot of these trade negotiations? I'd say yes. Other industries, that's where we kind of look at steel, aluminum. That's where we look at pharmaceuticals. That's where we look at all of the 232 investigations. The Trump administration is already telling you what industries we view as national security that we're going to try to protect. Does that end in unintended consequences? Too early to say in my mind.
Ed, we've got a little bit of time. Let's finish on a different kind of hawk, a fiscal hawk. The July 4th self-imposed deadline. How achievable is that in your mind?
So what we said is that May was for the House, June was for the Senate, July is to work this out, August is to get this to the desk. They love to put artificial deadlines in place. I do think there's a decent chance that the Senate could get pretty close to getting this done by July 4th. What I don't know is how much of the details need to still be worked out between the House and Senate. Right now, it seems like what the Senate is trying to do is work with the House, pre-negotiate this, not get into a conference committee, try to get it to the president's desk sooner rather than later. I've always said with DC, I've never taken the under on timing. I've always taken the over, with the exception of this year. This year, this Congress has actually been able to come together and get things done. So I wouldn't completely dismiss it. I do think July 4th is too early. I think August is the real deadline, but it's remarkable. This is the most expensive bill in the history of the United States, and it has been largely without too many pitfalls. There's been hurdles. There always will be, but this bill does get done.
You're a wise man, Ed, and we appreciate the framing. Thank you, sir. Ed Mills there of Raymond James on the trade negotiations between the US and China and the path forward down in Washington for the tax bill. Up next on the programme, we'll catch up with Bob Diamond of Atlas Merchant Capital on the state of the banking sector as we count you down to inflation data later this morning. That data, 1 hour away. Equity futures near session lows. We're down about 1/3%. 60 minutes away from inflation data in America. Going into that, no real drama. 3 days of gains on the S&P. Give it into just a little bit of weakness this morning. We're down by 0.2%. Similar move on the Nasdaq 100, down by 1/4. Two things to watch for the bond market. Not just the inflation data later on this morning, but also the bond auction. $39 billion of 10-year notes ahead of that $22 billion of 30-year bonds that are coming out tomorrow. So lots of supply from the Treasury in the next 24 hours. Into that yield, just bleeding a bit higher, up 2 basis points. points. The 10-year 449.38 at the very long end of the curve. Seemingly can't get away from 5%. 496 this morning, up another 3 basis points or so. That's the cross-asset price action with 2 hours until the opening bell. Let's get you some morning movers. Here's Yahara Anand with more. Hey, Yahara.
Hi, John. We start with Lockheed Martin. Shares are now down 2.7% after we here at Bloomberg reported that the Air Force requested just 24 F-35s for next year. That is half of the 48 that it had expected. This, of course, marking a major blow for Lockheed Martin since the Air Force is the jet's biggest customer. I will note that the request, which was sent to Congress, could still undergo substantial changes. And now that we have that out of the way, we can move on to the fun. Take a look at my next stock, Dave & Buster's. Shares are up nearly 7% here. And that's after executives said that sales are picking up at the restaurant arcade chain as summer is underway. I will add that the company doesn't have a permanent CEO right now, but investors obviously optimistic about the business. And if you think it's all fun and games here at Surveillance, well, it is. For now, we have our next stock, GameStop. Those shares, not fun are the moves. Shares are down nearly 5% because it posted weaker than expected results. Net sales were down 17% from a year earlier. And John, obviously that one was for you since I know you love to stay up all night playing video games.
Big gamer, massive gamer. I'm not a gamer at all. In fact, I think after 25, no one should play video games, but that's just my take on things. Do you? On our radar this morning, Yahara, thank you. Let's get back to our top stories. A curfew in place in downtown Los Angeles as anti-deportation protests stretch into a 5th day. Almost 380 people have been arrested since the weekend as crowds continue clashing with police over ICE raids. Elsewhere, the US and China reaching a trade compromise. Delegations from the world's 2 biggest economies striking a deal. Now awaiting sign-off from President Donald Trump and the Chinese leader Xi Jinping. And finally, the Treasury Secretary, Scott Bessent, is reportedly a top contender to be President Trump's next Federal Reserve chair. Sources telling us here at Bloomberg that a growing chorus of White House advisors are floating the Treasury Secretary's name. And they're the stories on our radar this morning. Let's turn to the financials. Citigroup expecting to set aside hundreds of millions of dollars more than it did last quarter for potential loan losses, a sign perhaps that the biggest US banks may be bracing for economic weakness. Bloomberg's Herman Chan joins us now with more. Herman, is that just Citi? Is that the industry? Is it just the big players, or is it the regionals as well?
Right. So there's some mixed messages with respect to asset quality in our view. On the one hand, we've seen the Citigroup announcement that they're adding to bad debt reserves. And that will happen for many players in the banking industry, given the fact that there's some potential weaker economic projections going forward, given all the uncertainty. On the other hand, we've heard from a number of banks at this week's Morgan Stanley Investor Conference that their clients are doing really well and they're absorbing the tariffs or passing on some of the higher pricing. So it's overall a bit of a mixed message, and we'll see how it all shakes out over the next coming quarters.
Herman, you cover the regional players as well. If you look across the economy right now, any pockets of stress that they're struggling to deal with?
Yeah, I would say there are pockets of increased scrutiny, but not yet stress. So areas like trucking, manufacturing, those sort of areas that are more directly impacted by tariffs are areas that the bank management teams are scrutinizing much more closely. But on the other hand, the bank management teams are also saying that the economy is doing okay so far. Customers are still spending, and that's really propping up asset quality for the time being.
We heard an update at the conference in the last day or so that corporate and consumer credit was looking better than had been expected. Is that in line with really what you were thinking too, or is that more of a surprise?
That's right. So when we were into the first quarter earnings, there was a lot of uncertainty about where things were trending, but overall, the banks were saying that credit quality, especially with the consumer customers and the commercial customers, we're still holding up fairly strong despite all of the headline risks. So that seems to be a continuation a few months later, and there's nothing really surprising on that front. A lot of the banks are talking about early indicators like criticized loans trending better throughout the year. So that's a good indication that the banks have, at least for now, a good handle on credit quality with respect to the commercial side.
Herman Chan with the update. Herman, thank you. Herman Chan there of Bloomberg Intelligence. We can build on the conversation with a perfect guest, Bob Diamond, the founding partner of Atlas Merchant Capital and the former Barclays CEO. Bob, good morning. Good to see you.
Good morning, Jonathan. How are you?
I'm good. It's good to see you, sir. Let's just recap things. Where are we right now? big 30,000-foot view of the banking sector in America. How are things shaping up?
You know, I think just kind of the back and forth, and on the one hand and on the other hand from Herman suggests pretty much my view, which is kind of a balance. I think we'll see a turnaround in deal making, in advisory in the second half of the year that was a bit slower than people expected in the first half. I don't think Wall Street will repeat the kind of trading performance they had, it was kind of like Christmas in the first quarter for trading desks with all the volatility. But I think it's a good environment. So no big warning signs. I think as you said, the report from Citi that loan loss provisions are a bit higher is not surprising. I would be very surprised if they're more than a bit higher.
An okay environment for the big banks or for the smaller banks as well?
Well, it's a great environment for the smaller banks. And as you know, we're very focused on regional and community banks. We've done our first close in a investment strategy for that sector. We think that the 4,500 regional and community banks, one, they're incredibly important to the economy. They do over half of the lending to small businesses and family-owned businesses, but 4,500 is probably the wrong number. And many of the smaller, more private community banks that are so important to their communities are frankly just too small to succeed, with higher technology costs, higher regulatory costs, higher compliance costs. And Jonathan, what we're seeing is with a focus of our banking expertise, our integration expertise, the CEOs of these banks want to take part in consolidation. The opportunity to increase ROE through cost synergies, particularly on in-state transactions, is terrific. So I think in addition to that, as you look at the go-forward business opportunity, we have higher rates. They're probably trending somewhat lower, but not too aggressively, and very high demand for credit. So the environment could not be better for a strong regional bank today.
Bob, we often hear that tariffs and rates act as overhangs on potential M&A and consolidation. But stepping back, there's also a tremendous amount of disruption going on at an industry level. AI is disrupting many industries. You still have this transition in terms of office and real estate post-COVID. You have the energy transition, and we'll see what happens with reshoring. So would you argue that disruption in and of itself is going to lead to more industry consolidation and M&A across various sectors?
Yeah, I don't think that's a bad hypothesis, particularly with AI. I think looking at financial services again, which is kind of our expertise and our focus, it's nothing but positive in terms of, in the first stage, greater efficiency. And even where there's been that disruption in the U.S., the U.S. economy around uncertainty and tariffs, we have a couple of broker-dealers that we're invested in overseas, Panmure Gordon in the UK and Kepler Chevreau in Paris-based, but really focused on Europe for equity sales, trading, and research. They both had record earnings in the first quarter for flows from U.S. investors into the UK equity market and into the European equity market. It's incredible to me every time we see these disruptions. It's like the markets are reacting almost before we're ready to do the analysis. So those are first quarter numbers at Panmure Gordon and Kepler Chevreau, and they're records for the firms in terms of flows from U.S. investors into the UK and into Europe. So it's amazing how agile the investors are.
I was going to follow up and ask you about that because I know you have a very global experience throughout your banking career. And it's also just stunning to think about how soon the January American exceptionalism thesis turned into Sell America after Liberation Day. Do you see those trends in terms of flows and sentiment moving away from U.S. markets continuing, or is it more of a kind of a near-term blip?
I think there are reasons to continue. So one of the reasons is it's been a big divergence almost since 2008 and the great financial crisis, certainly in banks, but really in equities in general. The outperformance of U.S. equity markets has been very clear relative to the UK and Europe. So you had a bounce coming, and I think one of the catalysts for that is this administration's kind of gave a boot in the butt for the Europeans to say we really have to focus on spending. We really have to focus on private sector. We really have to focus on the economy growing. And I think the attitude change across Europe and the attitude change in the UK toward private sector success, business, profitability has been positive for them. So I think the U.S. is still like the leading economy. It's so, the financial services industry is so deep. It's just such an impressive machine. It's not a negative on the U.S. necessarily. I think once we work through the uncertainty around tariffs, we'll see the strength. But a bounce in Europe and a bounce in the UK was coming.
Do you still see the policy mix from this White House as pro-risk, pro-growth?
I think, to me, Jonathan, the single thing that investors are looking for right now, well, there's not one thing, but if I picked one out, it's certainty. And I think, calming down the situation with U.S. and China would be a very big part of that. So I think the announcement today, if we move forward with solving some of those situations, I mean, keep in mind, if you go back like 10 decades, then, tariffs were like 2.5% on average. They got up to 25 or 30% with all of the noise. If they settle around 5 or 6%, I think we have confidence again and we have certainty again. I think we'll have deal making come back. So I think this is a big moment. And I think what's been recognized is that China actually has some pretty strong cards. Rare earths is one of them. But, as you look at the latest numbers, China still had an increase in exports. Exports to the U.S. were down 30%, but exports to the rest of the world were up 11%. So overall, their exports were up.
Up more than 20% to Vietnam.
Right. So less than 10% of their exports are to the U.S. today.
Dan, this is something you talked about. The last few months have revealed the leverage that the Chinese have this time around, maybe in a way that wasn't really enforced several years ago in the president's first term.
Yeah, absolutely. And I think there might be some positives that redirect and reorder some critical security-based industries, technology, pharma, medical supplies, et cetera. But I think the theme that I'm just hearing from Bob is one we just talked about with Ed earlier, which is this unintended consequences. We've given a kick to Europe to start spending and maybe in many ways created better growth opportunities for them that they wouldn't have taken on earlier, much like the DeepSeek analog.
Bob, does that mean that you're more focused on the US as everyone starts to look elsewhere? That maybe there's better opportunities here now? Relative
to the last 3 or 4 years, I think the opportunities in the UK and Europe are there. But Jonathan, one of the things we felt in Atlas Merchant Capital was one of our real competitive advantages in financial services is we're focused on the UK and Europe in the US. Prior to COVID, we had done just as many investments in the UK and Europe as we'd done in the US. Since COVID, it's been US, 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 because that's where the opportunities are. So I would say it differently. I hope we continue to see opportunities here. And U.S. regional and community banks writ large, that's a phenomenal opportunity in the U.S. But if you give us more opportunities for growth in the U.K. and Europe, then Atlas Merchant Capital is going to be very, very busy. And that's the direction it looks like we're going in.
Just give us the number quickly again. What are we at now? Regional banks in this country? 4,500?
4,500, and it's probably the wrong number.
And you've got us coming down to what?
I think 3 years from today, market down will be at 1,000 to 2,000.
It's a punchy goal, that's for sure.
Punchy goal.
You could be a big part of it too. Bob, it's good to see you.
Good to see you, John.
Thanks for dropping by. I appreciate your time. Bob Diamond there of Atlas Merchant Capital. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross back over to Yahara for more. Hey, Yahara.
Hi, John. NATO allies are considering allowing contributions to Ukraine's defense in their new spending target, which is set to be adopted at a summit later this month. Sources telling us here at Bloomberg that Secretary General Mark Rutte is seeking to keep the U.S. fully engaged by getting member states to allocate at least 5% of GDP for defense spending. Meanwhile, General Motors says it's planning to invest $4 billion in its U.S. plants over the next 2 years. It's expanding factories in Michigan, Kansas, and Tennessee. It's also moving the production of several top-selling models from Mexico to the U.S. as it seeks to mitigate an estimated $5 billion hit from President Trump's auto tariffs. And the feud between President Trump and Elon Musk appears to be cooling off. President Trump told the New York Post that he doesn't blame Musk for anything and says he guesses he could reconcile with him. That follows a post on X from Musk saying he regrets some of his social media posts during the height of the feud. Tesla shares are higher in early trading, up nearly 2%. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara in the next hour. Up next on the program, falling behind the curve.
Inflation comes down, the Fed is behind the curve, and we actually think them saying they're data dependent is not what they're doing. They're waiting to see what happens for the tariffs. They're going to have to probably cut more than the market thinks in the back half.
Tariff dependent and not data dependent. We'll get to that next with Mike Schumacher of Wells Fargo, live from New York. You're watching Bloomberg TV. Quiet start to the morning so far, picks up later on this morning at about 42 minutes from now when we get a latest read for you on US inflation data. Into that, the scores look like this. Equity futures on the S&P down by a little more than 0.1%, pushing 0.2% lower on the Nasdaq 100. Under surveillance this morning, the Fed falling behind the curve.
Inflation comes down, the Fed is behind the curve, and we actually think them saying they're data dependent is not what they're doing. They're waiting to see what happens for the tariffs, which means they're not data dependent. That puts them behind the curve, and they're going to have to probably cut more than the market thinks in the back half because they've been waiting and waiting and waiting when they should be looking at the data.
Here's the latest this morning on the data. Investors are awaiting May inflation data ahead of a Fed rate decision next week. The estimate in our survey expecting core CPI to increase by 0.3% month over month. Mike Schumacher of Wells Fargo writing the Fed is boxed in. Inflation will be high for about a year, then return to a pretty normal run rate. Mike joins us now for more. Mike, good morning. Good to see you.
Good to be
here.
here.
It's been too long to see you in person, sir. Thanks for coming back in. Let's pick up on that. What we just heard there from Matt Miskin, making a case that maybe this Fed risks falling behind the curve. Would you take the other side of that, given what you're expecting?
Not too much. I think it's really a feature, not a bug. The Fed wants to be, quote, late to the game. It wants to see evidence that inflation has peaked. It doesn't need low inflation, just simply some sign that inflation's not going a lot higher.
How much evidence will we see in about 40 minutes' time?
Not much. Probably see core come in at right around the survey, I would say, 0.28, 0.27, something like that. We have 2 decimal places now. People are paranoid about this, but not too much evidence yet.
Mike, how much are tariffs figuring into your inflation outlook? I mean, I guess just first thinking about this idea that vis-a-vis COVID first and then Trump 1.0, a lot of companies have flexed supply chains over the last 10 years. So is there going to be more flexibility in terms of people think in terms of the hit to inflation from tariffs?
Perhaps somewhat, but it's interesting when you think about the tariff effect. The markets tell a pretty tight narrative, actually. You've got inflation high for about 12 months and coming down to a pretty normal level. And that's actually what I think most economic models would tell you. And what can go wrong there? Perhaps there's a bit more inflexibility than we think. So we're still concerned. And I think, look, how much experience do any of us have with tariffs over the last 20, 30 years? Not much. That applies to the Fed, the ECB, any policymaker.
Absolutely.
You've got to be a little bit less confident going forward than otherwise.
And I would also just follow up to ask you about immigration. I mean, this has obviously been in the spotlight the last several days, and it's another part of this painful policy medicine that the White House is focused on first, in addition to trade. So how much are maybe the challenge or the slowdown in immigration trends hitting inflation?
Yeah, it's going to push up prices, I would think, in particular with some of the lower wage sectors. Think about agriculture, for instance, or some parts of leisure and hospitality. Who's going to harvest those crops in Texas, Florida? Not clear. You have to pay up.
Growth revisions in the US, super aggressive. I was reading the note you put out in the last week. You're doubting whether they've been aggressive enough in other parts of the world, including Europe. Just explain some of that for us this morning.
Yeah, I think it's interesting. When you consider really some of the trade-offs between the U.S., Europe, and elsewhere, I would say the U.S. economy's got a very asymmetric effect going on right now, John. You think about any downturn period of weakness in my career, got a lot of gray hair, I've seen a few. It's always the case when the U.S. gets hit, it's big enough that every other economy comes with it. And our thought here is it's going to be a more limited set. So Canada, yes. Mexico, yes. China, probably, depending on the outcome of these negotiations. But the rest of the world, not so bad, frankly. So it's not something we've seen before. Europe seems actually okay.
And just also from a global perspective, obviously a lot's going on in terms of trying to negotiate some détente in Ukraine. And on the other hand, another part of the world, Trump is negotiating with the Middle East in terms of flexing supply higher, oil prices lower. So how does that maybe global commodity picture pertain or blend into your inflation outlook as well?
Yeah, it's really interesting. I go back to the beginning of the Ukraine war in 2022. How long did markets really focus a lot on that war? couple weeks, maybe a month. So I think maybe the unwind's a little bit more intense, but probably not a lot more than that. And it sounds a little bit cold, but the markets look at things like oil and core commodities. If they move, markets care. If they don't, then they move on to the next hot topic.
We have had a supply shock outside of the labour market. It's in the commodity market. It's crude. Crude's a whole lot lower than a lot of people thought it would be. With that in mind, how difficult is it to build a case for sticky inflation with crude down, energy prices down as much as they already are?
Yeah, it's a great point, John. You know, when you've got crude oil down a ton, it's the most important commodity in the world by far. And I think you've got to look at that and say, well, is that reflecting the idea that growth is going to be slower, or is it purely an OPEC thing and the Saudis are playing ball? It's probably a bit of both, I would say. Somewhat slower U.S. growth, whether it's recession or not, probably is not really the key point, but slower than we had been helps. But I do think it's the Saudis really saying, hey, we want to help out a bit. We'll keep prices down. And how long does that persist? Tough call.
Crude in the 60s is certainly helping out. Let's talk about the bond trade. Push it through fixed income. This from PIMCO. Maintaining your bias to be overweight in the 5 to 10 year part of the global yield curve and to be underweight the long end. The long end has become almost toxic to so many people. Can you construct an argument to be long the very long end of the curve?
I basically share the PIMCO views. So how would we come up with some method or some approach to make the long end attractive? I think you can get cute. You could have Scott Bessent come out in a couple months' time and say, hey, guess what? We're really going to cut issuance of U.S. 10s, 20s, 30s. We'll issue more in 2s, 3s, 5s, whatever. That probably buys 10, 15, 20 basis points for a while. But it's not just a U.S. issue. That's the key point. Think about government after government increase in defense spending. You saw the NATO comment the other day going to 3.5%. Maybe that happens, maybe it doesn't. Still, does he make you more or less confident buying 30s? Much less. So I think a lot of those things would have to reverse. I'm very skeptical this surge in defense spending reverses. That seems like a secular shift. Come back in a decade, we can talk about that, but probably not today. It's pretty tough to get super bulled up. I think the main argument, John, is that you get something like a recession and people focus on real yields and say, wow, they're really exceptionally high. So I think, to me, that's the case for buying the very back end of the curve, but it's a tenuous one.
It ends at 450, 30's close to 5%, some auctions in the next 24 hours. Expecting any indigestion whatsoever?
I think a little bit on the very back end. So people still have very little appetite, but this is a well-told story. So perhaps the balance is swung a little bit too far. People are a little bit too bearish.
Dan,
longer
final word.
term negative.
Would you agree with that?
No, I think that makes sense. Absolutely.
It's good to see you, Mike. Thank you, sir.
John,
Thanks for dropping
pleasure.
by. Thank you very much. Mike Schumacher there of Wells Fargo and Dan Skelly of Morgan Stanley. Dan, thank you, sir. In the next hour, here's the lineup for you. Greg Peters of PGIM is going to join us to talk about this bond market. He'll stick with us through the hour as we work our way to US CPI data at 8:30 Eastern Time. We'll touch base with Geetha Raghunathan of Bloomberg Intelligence on media stocks. We'll speak to Seth Carpenter of Morgan Stanley and David Kelly of JPMorgan Asset Management. The next stop for this market, 8:30 Eastern Time. Inflation data just around the corner with equity futures down just 0.1% on the S&P and bond yields bleeding higher by a basis point or two. Your 10-year, 449.58.
We do believe that there's going to be volatility within inflation.
We will see the impact first in small parts of the CPI.
To think about it being stickier, you want to see it broadening out across the basket?
Still very much a stagflation story. We're only seeing the leading edge of the nervousness that's coming with the realization that we may be stuck in a higher inflationary regime.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. Inflation data 30 minutes away. The up and down 90 minutes away. Your scores look like this. Equity futures pulling back by just 0.1% on the S&P. Similar move on the Nasdaq following 3 days of gains on the benchmark in America. On the S&P 500, a 20% plus rally off the April low, just 1.7% shy. Just within 2% from all-time highs on the S&P 500. That's the equity market turned to bonds. Fixed income, 2-year, 10-year, 30-year, yields bleeding higher. Back towards 450 on a 10-year maturity. On 30s, getting closer and closer to 5% again at 495.62. Going into this data later on this morning, this hour. US CPI, 8:30 Eastern Time. Then later on this afternoon, an auction of 10-year debt before supply tomorrow on a 30-year maturity. That's your setup for the next 24 hours. We begin this hour with our top story. The US and China striking an agreement following 2 days of high-stakes trade talks in London. Your team coverage starts right now with Annmarie in the British capital, Tyler Kendall down in Washington, D.C. Annmarie, let's talk about the progress we made over the last 2 days.
Well, Jonathan, the progress is to implement something they already agreed upon 4 weeks ago when Scott Bessent, the Treasury Secretary, and USTR's Jamieson Greer met their Chinese counterparts in Geneva. Obviously, we've seen both sides have a tit-for-tat. They're claiming that they reneged on their agreements in Geneva, and that's what led us to these talks more than 20 hours in the British capital between the U.S. delegation and the Chinese delegation. Ed Mills of Raymond James put it to you perfectly. What we are talking about over those 20 hours is politically salient topics and goods. When it comes to things like the easing up of export controls, which is a national security concern for the Trump administration, and when it comes to getting in return for that rare earth and magnets, which is a huge piece of leverage Beijing has, not just on the U.S. economy, but on the entire world, given the fact that they control more than 70% of really these micro metals. That's what these 2 days of talks were about. We haven't even gotten into broader issues and potentially the things like purchasing agreement, which was really paramount of the Trump first administration. Howard Lutnick, the Commerce Secretary, speaking to me and a few reporters, Jonathan, yesterday, after midnight coming out of Lancaster House. Already Scott Bessent was on a plane back to Washington, D.C. for his hearing this morning. He put it really well. He basically said that they absolutely expect the topic of rare earth minerals and magnets will be resolved. But he talked about when China approves the licenses, then you should expect our export implementation will come down as well. So that is going to be the balancing act we will see play out for the next few weeks.
Tyler Kendall, let's talk about the balancing act down in Washington, D.C. The Treasury Secretary arrives back in the nation's capital. What's the message he's got for lawmakers on Capitol Hill?
Yeah, hey, John. Well, he wants to show lawmakers that they are making forward progress when it comes to a deal, because the White House really is motivated to show that they are moving this process along, considering that the talks with China really have sort of diverted the attention away from those other trade deals that they are trying to get done by that July 9th deadline that we're now less than a month away from. And really a big part of this is that the Treasury Secretary, often when he is on Capitol Hill, he tells lawmakers, yes, this is about tariffs, but also we have to look at the other parts of that economic agenda when it comes to taxes and deregulation, too. And of course, this is the perfect audience for that. He's going to be in front of the House Ways and Means Committee. The chair of that committee is Congressman Jason Smith. He's the lead tax writer in the House, and they are waiting on those final changes from the Senate when it comes to the reconciliation package. And this administration is really pushing that this all goes hand in hand as they are trying to use tariffs also as that revenue raiser to help offset the broader impacts of that bill.
Just hearing from the president right now, Annmarie, in real time, the president's saying a deal with China is done. We will provide to China what was agreed to. Was this largely in line with what we're expecting this morning?
Well, yeah, because Howard Lutnick told us that him, Jamieson Greer, Scott Bessent will take all of this back to the President of the United States. They said to me that they have been on the phone communicating with the president as they've been in London. And the Chinese delegation, which said the talks were frank, rational, honest, we're going to take it back to Xi Jinping. But I think the Commerce Secretary put it really well yesterday when he said, we expect those rare earth metals, those magnets, to come to the United States at a more advanced pace, and then we will ease up on the export controls. So they are just implementing, Jonathan, what they agreed upon 4 weeks ago. So this really feels like Geneva Part 2. And this was 4 weeks to de-escalate those escalations we saw only since Geneva. I think we just need to remind our audience that this is a long road ahead when it comes to the tariff and non-tariff barrier, these trade discussions, these national security concerns between these two economies.
Annmarie, Tyler Kendall, to the both of you, thank you. We've talked about this a few times. The last round of talks, 18 months to achieve a phase one deal in the president's first term. 18 months started in July 2018, concluded in January 2020. On the screen there, you can see the statement from the president. So let's talk about it verbatim. Our deal with China is done. Subject to final approval with President Xi and me, full magnets and any necessary rare earths will be supplied up front by China. Likewise, we will provide to China what was agreed to, including Chinese students using our colleges and universities. We are getting a total of 55% tariffs. China is getting 10%. Relationship is excellent. Thank you for your attention. To this matter, the latest on the trade story. The conversation pushes towards the economic data later in about 24 minutes' time. Will we see some pass-through from those tariffs to the inflation data? Then later on this afternoon, will we see some pushback from investors with the debt market receiving some more supply? 10-year maturity later on this afternoon, 30-year supply coming tomorrow. Here's the view on Wall Street. Greg Peters of PGIM writing the following. The market is worried about fiscal troubles globally. Leaning into risk into this environment is a fool's errand. Greg joins us now for more. Greg, good morning.
Good morning.
Let's pick up on that last line. Why do you believe it's a fool's errand right now?
Well, I've been surprised at how welcoming the market has been without any details, right? We're just talking about this latest, rocks for chip deal out of London. Details matter, right? And we're supposed to be detail-oriented investors, and the markets are really trading on kind of ideas. And I think ultimately we need to follow the data, which is why CPI and other things matter a lot, not just trade kind of these headlines that have no depth to it. So as a consequence, I think just chasing risk at very expensive levels doesn't seem to make a lot of sense to me.
As you know, we're trading the mood music because the data hasn't changed much, and people believe the mood music might inform what the ultimate data will look like further down the road. The data so far has been okay. I stress okay, and we could debate how okay. There is a belief that there will be a bill due in the coming months through the summer. We've talked about that throughout this morning. Are you expecting some kind of payback from the front loading we've seen over the past few months?
I do. Our expectation all along before, kind of the administrative moves was the economy is slowing. The question is how much. I think over the next quarter, you'll see the pull forward, so the data is going to seem a little more strong than it actually is, more of a mirage. I think the second half you'll have a better read. But that's highly contingent upon getting clarity. I think what's being lost here, even though everyone talks about uncertainty, we need clarity to make decisions from a business standpoint, from a consumer spending standpoint, and the longer this goes on, I think that lack of clarity translates into just lower economic activity.
From the investor standpoint as well. So growth at the start of the year in our survey was looking like something around 2%. Now it's closer to 1%. Inflation data around 2 to 2.5 for CPI at the end of the year. Now it's closer to 3. That 3, how sustainable is inflation closer to 3 versus, say, closer to 2? And do you see a source for sustainable inflation, not just in the policy, but across the economy through the year and looking out to 26 and beyond?
I do. I think inflation is clearly in the system. History tells you that once it enters the system, it's hard to shake out. So I don't know if it matters if it's 3.2, 2.8, as long as it's persistently above 2%, that target. I think that's what matters. And why it matters is because it translates into the Fed reaction function, right? So I think the markets have been so comfortable over the past, just call it 15 years or so, where any market swoon, the Fed would be there. It's harder to be there and to do much when you're above your target. And I think that's being lost in the conversation here. So I don't get caught up on the actual number.
Sure.
I get caught up on the fact that you're persistently above, and being persistently above just constrains those degrees of freedom relative to where we were when the Fed and other central banks were happy to be quite easy in hopes of generating inflation. So you have the opposite effect, and I think the market reaction will be quite different this time.
It compromises the dovish bias of the Federal Reserve. When you say the market reaction will be different, what are you saying? That we have to accept more pain, if there is indeed pain, than we otherwise would?
Yeah, the Fed just can't simply come to the rescue. The market's really comfortable with these idea of puts, right? These free puts, whether it's the Fed put, now it's the taco put, all these types of puts, right? Right? There's no such thing as free options and free lunches. And so I think the pain threshold is very different today than where we were, just before COVID, I guess.
That's risk and risk assets. Where does that leave 30s, 10s, the longer end of the yield curve? Do you consider that part of the risk asset bucket?
Sadly, I do.
Do you really?
I mean, it's not behaving in the way that it has over the past N number of years. And the reason why that is, quite simply, is the debt and deficit, of course. and the uncertainty and thus term premium. And so investors want to get paid more to be out the curve, to take on that type of risk. And so, our view all along has been the curve will steepen. I think one of the easier trades, Trump trades 2.0, was a curve steepener. That's playing out. The question is how much will it continue? And I still think there's scope for that too.
Do you think that's a US-centric story or a global one?
It's a global story. But the U.S. matters a lot, of course, right, in the global bond story. But, what you're seeing in Japan, what you're seeing in Europe, and, watching swap spreads globally is a really interesting phenomena where, the U.S. Cash market has been trading cheap for years now. Europe has the opposite effect. But what the swap market is telling you is that there's abundance of collateral and people are kind of pushing back on it. And yield levels, maybe aren't cheap enough.
We'll get through the inflation data later. Let's talk about the debt auctions. If you don't think yield levels are cheap enough, what kind of levels do you think we need to achieve to clear the supply that we're going to see in the next few years?
Well, it all depends on kind of where the front end and growth and inflation. So there's a myriad of factors,
lots of different things happening.
But to me, just the onslaught of debt, right? So we're focusing on one auction, but then there's another one and another one and another one. And I think the cumulative effect matters. You have to watch some of the kind of the regulatory moves as well. Some might be positive, some might be negative. But either way, I see it trading cheap for quite some time.
5% is not cheap on 30s. Is essentially what you're telling me this morning. It's not cheap enough.
Evidently not. But
so you're looking for something closer to 6 on the long end of the curve?
No, I mean, it's clear, it's undeniable. Like there is this 5% threshold where investors get excited. So what we're seeing right now is it hits 5% and it does garner this investor demand. But it's a moving target. So it might be 5% today, it might be 4.75 tomorrow, and 5.25. And so either way, I think the point is that there's so much debt that needs to get refinanced here and financed, and that doesn't even include the additional debt coming from this bill. It's a never-ending story. So it's wave upon wave upon wave.
Greg, you're going to stick with us, I'm pleased to say. Greg Peters there of PGIM Fixed Income, going into that additional supply later on this afternoon and again tomorrow. Bond yields this morning higher by 3 basis points at the very long end of the curve. On a 10-year up also by 3, closing in on 450 going into inflation data a little bit later this hour. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross back over to Yahara Anand, who has more. Hey, Yahara.
Hi, John. We start with the latest from the president on trade. He says the trade deal with China is done. Trump says the U.S. will provide China what was agreed on in talks over the past 2 days in London. Trump added the deal is subject to Chinese President Xi's approval. Meanwhile, here, California Governor Gavin Newsom is accusing the president of abusing his power by mobilizing troops in Los Angeles. Newsom issued a warning to other states saying, quote, California may be the first, but it clearly won't end here. Protests in LA over immigration raids stretched into a 5th night last night, and parts of the city's downtown are now under curfew. And a short list of names is emerging to be the next Fed chair. Sources telling us here at Bloomberg, a growing chorus of advisors both inside and out of the Trump administration are pushing for Treasury Secretary Scott Bessent to replace Powell when his term is up next year. President Trump said on Friday he would name a successor very soon. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate the update. Up next on the programme, the Morning Calls Plus. We'll catch up with Seth Carpenter of Morgan Stanley, David Kelly of JPMorgan Asset Management, reacting to inflation data just 15 minutes away. A statement from the president just moments ago. Let me share it with you. Our deal with China is done, subject to final approval with President Xi and me. The president posting that on social media just moments ago following 2 days of talks. Another round of talks in London between the US and Chinese delegation. The next stop for this market will be inflation data about 12 minutes from now. Your scores going into it shaping up as follows on the S&P 500. Almost unchanged really, no drama here. We're down by 0.1% on both the S&P and on the Nasdaq. In the bond market, yields are bleeding a little bit higher. 450 on 10s, let's call it. Let's round that up on a 30-year yield, getting closer again to 5%, 495.83. Then after we get inflation data, we'll hear from the Federal Reserve a week today. Greg Peters still with me. Greg, I've got to ask you, how much attention you pay to the forecast when the man overseeing the Federal Reserve, or woman for that matter, of course, might be very different to Chairman Powell in 12 months' time?
Yeah, so I mean, there is this belief that if you replace Powell, it'll be a much more dovish Fed. But I'm not convinced around that. You know, I think there's a difference between lobbying for the job and getting the job and then protecting your legacy. You know, I don't think, any Fed chair wants to be known as someone who, took inflation, to a much higher plane, right? The Burns legacy.
You think
really
the weight of the institution will shape the individual?
I do think that. So it might be a bias. So what are we talking about? Maybe 25, 50 basis points tops. It's not going to be the 100. It's not going to be radically different. So I think it's noise. The shadow Fed, I think, is also noise. I don't think it's positive noise, by the way. It just shakes the kind of the stability of the institution itself, which matters and matters a lot. But ultimately, it's a board. I don't see it being radically different. Maybe on the margin.
That board gets together a week today to come out with a decision, a statement, a news conference, and some new forecasts from the Federal Reserve. Some new forecasts that will incorporate the latest economic data. CPI, once again, drops at 8:30 Eastern Time. The price action at the moment, equity futures negative by 0.1% on the S&P. Want to fit in some morning calls as well, so let's get to that. First up, Citi, raising its price target on Microsoft to 605, expecting growth in the company's Azure cloud service. That stock is down by 0.25%. Your second call from Baird, downgrading United Health to neutral, seeing risks to the path forward and the company's long-term trajectory. And your third and final call from Bernstein, raising its price target on Disney to 125, noting the stock has been on, quote, a roller coaster over the past 3 years. Let's stick with Disney. The CEO, Bob Iger, saying he plans to hold on to the company's traditional TV assets after streaming competitor Warner Brothers Discovery announced plans to split in two. Joining us now to discuss is Geetha Raghunathan of Bloomberg Intelligence. Geetha, welcome back to the programme. What's the difference in approach between Disney and a major rival?
Yeah, thank you so much, John. So really the difference here is the amount of exposure that Disney has to the linear TV ecosystem, and that is really much smaller than some of its rivals. So you think about Warner Brothers Discovery, for instance, which announced that split just a few days ago. About 85% of their profit last year, John, came from the TV networks. Compare that to Disney at about, under 10%. It's a really different story. For Disney, it's really all about their parks business. About 55 to 60% of their revenue, really, or rather of their profit, comes from the parks. So TV not such an important part of the puzzle for them, really.
There is a piece of the puzzle on the TV side that's finally fitted into place. It's Hulu. Geetha, what's going to happen now? Disney has got its hands around it completely.
Yes, so now they have 100% control of Hulu. This is what they had wanted. The other 33%, so 1/3 of it was owned by Comcast. There was this fear out there that Disney would have to pay a much bigger amount to Comcast to kind of finally close the deal at about $5 billion, but that number came in much lower than expected. It was about close to $440 million. But really what this is all about, John, is about bundling. And with them getting Hulu, full control of Hulu, they can integrate it into the Disney Plus bundle, into the upcoming ESPN product. And remember, right now, the game in streaming is not about subscriber acquisition. It's really about subscriber retention. And gaining full control of Hulu allows them to do that. We know that having bundles curbs churn by something like 40 to 50%. So this is really what Disney's strategy is all about.
Geetha, I love Hulu, but I say this all the time. We're reaching the limits of my price tolerance, that's for sure. They keep putting prices up. In a moment, we'll get US CPI. As you look across the industry that falls under your coverage, how much consumer pushback are you witnessing, if any, at all?
Yeah, there definitely is. I mean, you do have the clear streaming winners, in Netflix, a little bit in Disney, which obviously have much more pricing power. But then you look at some of the other services. You look at a Paramount Plus, for instance, or a Peacock. Obviously, they have very limited pricing power. So we are kind of definitely reaching that point. But then content does become a differentiator there. So we've seen some of the leading streaming services still being able to take those price increases and keep their subscribers.
Geetha Raghunathan of Bloomberg. Geetha, thank you for the latest on the media sector and the price pressure we're all witnessing over the past few years on that front. CPI data is just around the corner. Mike McKee's going to join us now for a preview. Mike, we've been asking all morning, is it too soon to expect the tariff push through, the feed through, the follow through in this data? What are you expecting?
Well, we're starting to expect the clouds coming over the horizon, John. We may get some categories, particularly goods prices that come in from Asia, showing some increases. Also automobiles, because of the tariffs that the president put on. Not a huge amount of tariff impact, and there is a feeling that some service industries went down in price, airfares, for example, and that might limit the damage to the overall CPI. But it will be a sign that this is coming. And most analysts in their notes ahead of this are saying July, August, watch those numbers. June, July, August, watch those numbers.
Mike, are they saying it gets worse, not better from here?
Oh, yeah, gets worse from here. Because the tariffs are going to go on, and we don't know what the reciprocal tariffs will end up being, but we've already got the 10% tariffs. We've got the aluminum and steel tariffs, and then you've got pharmaceutical tariffs coming. Lots more tariffs to come, and that will just continue to add to the prices that you have to pay.
Mike, stay close. 6 minutes' time. Mike McKee's going to break down that economic data for you. Greg, just to come back to you. Mike's saying the base case right now. Consensus view, might be wrong, gets worse, not better from here on the inflation front. Do you agree?
Absolutely agree. It's way too early to be definitive, draw any conclusions. It's like the amuse-bouche of what inflation readings. We have a lot more courses in front of us, and this is very early on. This is just a little bite.
Not exactly tasty stuff, is it? Last time we got the SCP from the Federal Reserve, there was almost a dovish celebration that they viewed this, implied by the forecast, as a one-off hit, and inflation comes back down again in 26. Predates some of the tariff conversation. Does it change next week?
No, I think it's too early. The Fed definitionally has to be reactionary to this, right? They can't be out in front because they don't know what they're out in front of. And so, you'll continue to see a Fed on hold waiting for the play to develop, so to speak.
Does that include considering interest rate hikes? Because I haven't heard them entertain that idea at all, really.
That's not in the price. Let's put it that way. So I think that would be a shock to the market. I don't think that's anyone's base case by any stretch. But it depends how it unfolds. But the Fed believes, and I think market participants believe that it is a one-time hit.
Greg Peters of PGIM is going to stick with us in just a moment. It's the data point you've all been waiting for. Inflation data in America just around the corner. We'll catch up with Seth Carpenter of Morgan Stanley, David Kelly of JPMorgan Asset Management here to react. Greg Peters as well, and Mike McKee will be breaking down the numbers in just a few minutes' time. From New York City, this is Bloomberg. Inflation data just seconds away, 20 seconds around the corner. Going into it, your scores shaping up as follows on the S&P 500. Negative by only 0.1% on the S&P. On the Nasdaq 100, we're down by not even a tenth, negative 0.06%. That's the stock market and fixed income. Treasuries, 2-year, 10-year, 30-year yields bleeding high at the long end by 3 basis points. The 30-year yield, 4.95.93. With the inflation data, here's Mike McKee. Good morning, Mike.
Good morning, John. Well, on a headline basis, certainly better than anticipated, up just 0.1%. The core is up just 0.1% as well. Last month was 0.2 for each of those, and the forecast was for a 0.2 rise in the headline and a 0.3 rise in the core. Now, for a year-over-year number, we do go up on a year-over-year basis to 2.4% from 2.3% for the headline. The core stays the same, 2.8%. So if there is a tariff effect, it is very small in these numbers. According to the BLS, the index for shelter rose 0.3% in May, same as it did last month. That's the primary factor for the all items monthly increase. Food, though, did go up 0.3. That was expected. An increase was expected there. Energy declined a full percentage point as gasoline fell. So that suggests that the services inside of the equation probably played a role in holding down overall inflation. I'll dig into the numbers and you can dig it in the markets.
Yeah, Mike, thank you. Stay close. That's what we call the right kind of downside surprise. I imagine we'll hear from the president momentarily. He'll have things to say about this. A downside surprise on headline CPI, on core as well. As Mike said, CPI month over month coming in at 0.1%. Our survey said 0.2%. That was the median expectation in our survey of economists. Excluding food and energy, core CPI month over month 0.1%, a much bigger downside surprise. We were looking for something closer to 0.3. This is how it plays out in the equity market first. Equity futures positive, bouncing off the back of it by 0.4%. On the Nasdaq up by 0.5. The outperformance, as you might expect, on the Russell, the small caps, the Russell 2000 up by more than 1 full percentage point now. Turn to the bond market. 2-year, 10-year, 30-year, focus on the front end of the curve on twos. Yields dropping by 5 basis points. Yields were up across the curve into the print, lower off the back of it, down 4 or 5 basis points on twos to 397.23. And once you've had a move like that, you unlock a bit of dollar weakness. So turn to foreign exchange. Euro dollar shaping up as follows now, near session highs. Euro dollar positive by 1/3%. Some euro strength, some dollar weakness. Euro dollar 114.66. With me around the table, Greg Peters of PGIM, Seth Carpenter of Morgan Stanley. Seth, just your first take off the back of that data. Not in line with what you were expecting.
No, that's exactly right. We were expecting roughly with consensus that it'd be up, 2-3 tenths on core. I think one thing that's important to remember, though, is there are lots of moving parts here. We had already seen lots of swings in things like used cars before. We are coming into this year on a deflationary trend or disinflationary trend. And so, I think we got to just take this as 1 month's worth of noise. The other thing, though, is it's still early game. So when we look at what happened before with tariffs, it did take 2 or 3 months before you saw any sign of the tariffs and the inflation data. And so I think this is still the beginning of the game, not the end of it.
Timing and sequencing is really important. I know you've done the research because I've read it. The data this morning, you called it noise and not signal. What was the experience of the tariffs in the first term under this president and the timing and the sequencing of things, the hit to inflation, then the hit to growth? And why should we think it's going to be the same this time around?
Yeah, I mean, I think what's really tricky is it does seem like the inflation comes from the tariffs after 2 or 3 months. The hit to growth comes after 2 or 3 quarters. And so that mismatch in timing, I think, makes it hard for markets, but very hard in particular for the Fed. I think in 2018, one of the big changes then versus now is that it was mostly focused on China. If you look hard in the core consumer goods data, you can see the effect of inflation, but it was transitory then. We have every reason to suspect it'll be temporary this time. But the numbers are bigger now. All around the world, tariffs, bigger tariffs on China, modulo whatever sort of deal comes out from London. And so we think there's a big difference there. Also muddying the waters, though, we know how much front running there was before the tariffs coming in. So is that going to change a little bit the pricing dynamic? Easily could do.
Greg, would you fade any excitement this morning around this print?
I would. I agree with Seth. I mean, it's way too early to make any kind of determination around this particular number. The one question I have for Seth, though, is,
Sure.
How do you think about 2 components? The housing component, which is key because that also feeds into growth, and then the service sector, which is basically a measure of wages and labor health. So, a lot of investors are excited around services disinflating, but that's actually kind of very much a double-edged sword. How do you kind of think about that?
Completely agree. It's a double-edged sword, and I think it's complicated. I think from the housing, it's a national phenomenon, and it really will reflect the tightness in the labor market. We've been expecting that to continue to drift down close to pre-COVID rates, month on month, maybe not going below it, but getting close to where it was before. For the rest of services, though, I think we have a countervailing force that needs to be more on people's radars. When it comes to policy effects on the economy, on markets, everyone's been focused on tariffs. Don't forget we've got immigration restriction. Immigration restriction matters a lot. We think prior to COVID, the run rate, sort of break-even rate for non-farm payrolls was probably 110, 120K. 2024, 2023, that run rate went up to 240, 250K. It's going to drop to something closer to 75. That's a meaningful restriction in the growth rate of the labor supply. And people here should remember what it was like coming out of COVID when it was hard to find workers. You saw hotel buildings, for example, where like the top 10 floors, for example, were just left vacant because they didn't have staff. I think those sorts of staffing shortages are very plausible, and that could be putting upward pressure over the second half of the year for the services outside of housing.
Not much pressure right now. If you are just joining us, a downside surprise on headline and core CPI. Month over month, it came in at 0.1%. The median estimate in our survey, 0.2 on core. Taking out food, taking out energy, it came in at 0.1 against the median estimate of 0.3. Mike McKee standing by. Mike, I want to come back to you. You've been digging through the details. What's the source of this downside surprise? Where's the surprise coming from?
Well, overall, John, it looks like goods prices did not rise. They were flat during the month, which is not what was expected. Services prices were down. Gasoline prices fell 2.7%, so that had a big weight. The thing that did prop up inflation was, as you guys have been talking about, housing, but a couple of other areas that did surprise. We saw a slight rise in home furnishings, about a 0.2%, but apparel is down by 0.4. That was expected to rise. And here's the real surprise in these numbers. Used cars and new cars both fell in price by 0.5 percentage point. The expectation was tariffs would drive those higher. Airfares were down, as people kind of expected, given the travel fall off that we've seen, down 2.7%. So there are some surprises, some non-surprises in here. I was going to mention, John, you were talking before the number came out about the cost of Hulu and all those other subscription services. They were up 0.6%, one of the larger rises in the CPI this time. I think maybe what we're seeing is companies selling out of the inventories that they pulled in. That could be one of the explanations for not seeing kind of the tariff effect that we thought of.
And Mike McKee, thank you, sir. We're all feeling that price pressure on the Hulu side of things, that's for sure. I'll talk about that another time, no doubt. Seth, what did you make of that explanation?
Yeah, I mean, I think what Mike said was there are a lot of different components that are going in lots of different directions. And I think that's exactly where we've been for the past, call it, year, where the underlying trend before the tariffs hit was a downward trend, but boy, was it not uniform. It was all over the place. I think the car prices point is a really important one. If you look at the month-on-month changes of both new autos and used autos over the past, call it 12 months, you'll see some big swings in both directions. And so again, the noise versus signal, the noise is very high right now.
Seeing some swings right now in the equity market and in bonds too. Equity futures near session highs going into the opening bell about 50 minutes away. The equity market is positive by 0.4%. Just move to the bond market, though. This interesting move here. Compare the 2-year to what the 30-year is doing this morning. People like Greg would call this a bull steepener. Rally at the front end of the curve. Yields dropping by 6 basis points. And a 30-year basically doing nothing. What does that speak to?
That speaks to everything we were talking about, which is, all the concerns manifest in the 30-year, right? So the front end is driven by Fed policy, and the back end is driven by a lot of other factors. And there is this pesky auction later this week. And so I don't really see a scope for that to rally into that auction. It normally cheapened up beforehand. So I expect it to continue to cheapen up beforehand.
A 30-year supply coming tomorrow afternoon, 10-year maturity. Issuing debt, the Treasury a little bit later on this afternoon too. So yields lower at the front end of the curve. We're down 6 basis points on 2s. That unlocks some dollar weakness. Euro dollar right now, 114.75. Joining us now to extend the conversation, I'm pleased to say, is David Kelly of JPMorgan Asset Management. David, I just want your initial reaction to the data we got about 10 minutes ago. Was that a surprise to you, sir?
Not too much of a surprise. As we were going into this print, we were looking at a lot of the different industries, and there's a sogginess in the economy which is really preventing prices from going up. I mean, one of the things that I was struck by was that both airline fares and hotel lodging were down. And that really jives with the fact that, people flying and people staying at hotels in terms of occupancy rates have both been very solidly down for weeks, if not months here. And then at the retail level, I think it's just like businesses and consumers are eyeing each other nervously. Consumers, feel badly about the economy, not sure, and retailers just don't have the nerve to raise their prices until they absolutely have to. But I think the tariffs will mean they absolutely have to in the next few months, because a lot of these retailers work off tight margins. So I think we're going to have a further delay to the delayed reaction to these tariffs. But if the current level of tariffs stick, we do still expect this inflation pressure to rise over the months ahead. And I think by the end of the year, we're talking about a CPI about 3.5% year over year, consumption deflator north of 3% year over year, even though it's taking some time for this to materialize.
David, here's a counterpoint. It comes from Neil Dutta of Renmac this morning, who said if tariff rates are up and core good prices aren't up by as much as the consensus thought, it implies more margin squeeze at retailers and less price pass-through. Why isn't that just going to be the sustainable story through the next several months? Why does it have to get worse?
Because the retailers won't be able to do it. I mean, these margins are tight, and what they're doing is, for their existing margin, existing inventory, they pay a certain price for it, and they're willing to, even though inventories are going down, they're willing to, accept current margins. But as they have to pay for the new inventory and mark up on that new inventory, I expect that we will see those higher prices. So it's because margins are tight in the retail businesses, and I think it's going to be very, very hard for retailers and auto dealers and so forth to actually maintain low prices if the prices of the stuff that they're buying goes up.
David, if they're not in a position to eat it, are consumers in a position to pay the higher prices? Do you see a labour market that's tight enough to demand higher wages to fund that move?
Well, we are seeing a slight tightening in the labour market because, as your previous guests were talking about, that I think this immigration squeeze is beginning to hit. And I think it's very, very much below the radar because a lot of these people don't really admit to being working at all. But there's a shortage of labour, which is getting worse. And I do think that's going to put a floor under wages. And now for consumers overall, this is a tax on lower and middle income consumers. I mean, that's what tariffs are. They're a tax on imports of goods, and that hits low and middle income consumers. So it depends on the tax bill a bit, but assuming the effects of the tax bill don't kick in until later, then I think the squeeze is going to get worse over the course of the year, and you're going to see weak consumer demand, and so you're going to have a combination of an economy which seems to be pretty sluggish, say in the third quarter, but also prices which are registering pretty high year-over-year increases.
David, I've got to ask you, where on earth does that leave Chairman Powell and this Federal Reserve?
I think they have to wait and see what happens with this tax bill. You've got tariff inflation that's going to be followed by stimulus inflation unless they water down this tax bill. And I think he's right to wait and see. I mean, I also think that given how high the stock market is, he doesn't want to be responsible for causing a further party in the equity market and pushing asset prices even higher. So I think the Fed is going to wait and wait and wait until they know what the tariff story is and what the tax story is. And at that point, they can assess the economy. But until that point, they've really got no reason to ease.
David Kelly of JPMorgan Asset Management. David, thank you. Seth, you were following that conversation. Do you share that opinion the Fed's going to sit this out?
I do think so. I think right now there's no urgency for them to move. I mean, you saw the year-on-year number. Even with this downside surprise, the year-on-year number was 2.8. I haven't seen what my team has sort of done for the translation to core PCE, but you're still probably talking about something like 2.5%. And so even though that's well below the peaks we saw coming out of COVID, 2.5% is still a 0.5 percentage point higher inflation than the Fed's target. And to date, we haven't seen any deterioration in the labor market. So I think it's a very difficult proposition to argue the Fed needs to cut in June. Why not take the optionality, sit and wait? They can communicate their inclination to have the next move be a cut through their dot plot of the upcoming meeting. That seems fine, but I don't think there's any urgency on their part to move.
Have you got a clean read on their reaction function? They might not move, but do you have a decent understanding of how they would move based on incoming information?
So I think so. I think the simplest version of this, and this isn't going to be groundbreaking, is they've got two mandates. They have to worry about growth and employment on the one hand, they have to worry about inflation on the other. At any point in time, based on the current set of the data and then your best guess as to where things are going, which one's the bigger problem, and react to that one. And so right now, the bigger problem is very clearly inflation. It's come down, but it's still above target. The labor market to date is fine. Where are things going? Well, we start to make forecasts. We think inflation's going to go up from here. They probably think inflation's going to go up from here, but we don't know that yet. But until you get that confirmation, there's no reason for them to move. If we're right and inflation does go up, like I think is the consensus, before the labor market starts to slow, before spending in the economy starts to slow, well, that just reinforces the idea that inflation's the bigger problem of their two mandates. And so we've been saying for a while, don't count on a rate cut at all this year, because if inflation keeps drifting up before the economy cracks, it makes it easy for them to just sit on their hands at the current level of policy rates.
Greg Peters, sitting on your hands through the summer is one thing, through the year is another. Are you expecting them to sit on their hands through 25?
It's data driven, of course. That's my out. But we've been kind of penciling in 2 cuts just to get to kind of the top end of neutral. But it's a complicating factor. I think it's how you position the inflation. Clearly, they're going to be hesitant to use the word transitory. But there is this belief that it's a one-time shock, and you have to look through it. But my read is that they will prioritize growth. If you just kind of think about it, in the matrix, if growth moves down hard, I think we're pretty sure inflation's following, right? So I think they're worrying about and prioritizing growth over inflation, but they can't tell you that because they need to be credible on the inflation front. So you have to kind of look through, and kind of read in between, which is difficult to do.
Is that another way of saying Governor Waller has a luxury that Chairman Powell doesn't have?
Yes, but I think it's right, and there's some politics there too, right? So it's but our belief is inflation rolls over. Growth rolls over. I think they'll respond to that, even though inflation remains, well above target.
Greg, this was smart. It's good to see you, as always. Greg Peters there of PGIM alongside Seth Carpenter of Morgan Stanley. Seth, thank you, sir. Appreciate it. If you are just joining us again, just moments ago, and welcome to the programme, we got inflation data. Downside surprise, 0.1% against an estimate of 0.2. That's month over month on headline. If you look at core and strip out food and energy, that came in at 0.1. The estimate was 0.3. In response to that, equities higher, up a third of 1% on the S&P, up by more than 1% on the Russell. Bond yields are lower at the front end of the curve, unlocking some dollar weakness against G10 currencies. Euro dollar near session highs. I imagine the White House is going to respond soon as well. Bloomberg's Tyler Kendall joins us now for more. Tyler, we call that the right kind of downside surprise, not just for the economy, but maybe for the president too.
Yeah, hey, John, it's going to be a welcome report for this White House and expected to bolster the president's rhetoric when it comes to his tariff plans, particularly on the heels of what was considered to be a pretty big win for this White House last night when a court ordered that they can continue to invoke their tariffs under the International Emergency Economic Powers Act, IEEPA, at least for now until a hearing during the summer. So President Trump is going to probably double down on this message. And as you've been discussing, though, this really does come against the backdrop that this is sort of the beginning for the tariffs. We're not expecting them to go away anytime soon. And we also know those Section 232 tariffs are in the pipeline on the grounds of national security concerns such as pharmaceuticals. And that's why you're also going to see the White House push on that pressure when it comes to getting the House to pass that reconciliation package, because they still want to get cash into consumers' pockets as quickly as possible to get ahead of any certain tariff impacts here. That's really why we started to see that front loading of those tax cuts as part of this reconciliation tax bill, because they're trying to sort of front load those at the end of the day, even if there are those deficit concerns down the line.
Tyler, thank you for the update down in Washington, D.C. Tyler Kendall there, Bloomberg's very own. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross back over to Yahara, who has more. Hey, Yahara.
Hi, John. We start by recapping the latest economic data. Underlying U.S. inflation rose in May by less than forecast. It's the fourth month in a row that's happened. Core CPI rose 0.1% from April, lower than the expected rise of 0.3%. The data suggesting companies are finding ways to limit how much higher costs from tariffs they pass through to consumers. Meanwhile, President Trump says a trade deal with China is done. Trump says the U.S. will provide China what was agreed on in talks over the past 2 days in London. Trump added the deal is subject to Chinese President Xi's approval. And SpaceX called off a mission that was supposed to take off this morning. 4 private astronauts were scheduled for liftoff to the International Space Station with NASA and Axiom Space. The launch was delayed to fix a liquid oxygen leak that was found during inspections of the rocket. SpaceX says a new launch date will be announced once the repairs are complete. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next on the programme, we'll set you up for the day ahead. A sneak peek of the calendar through the rest of this week and into next week. Live from New York City, you're watching Bloomberg TV. Three-day winning streak on the S&P 500 going into the opening bell about 37 minutes away. We're looking for day 4 now. Downside surprise on CPI, unlocking some gains this morning, albeit small gains. We're up by 0.2% on the S&P. On the Nasdaq, up by 0.25. In the bond market, yields lower, particularly at the front end of the curve. We're down 7 basis points, 394.52. And with that move, unlocking some dollar weakness. Euro dollar 114. 65. As we count you down to that opening bell, just a sneak peek of what to look for today at 10 a.m. Eastern Time. The Treasury Secretary Scott Bessent testifying on Capitol Hill. At 1 p.m. Eastern, a White House press briefing. Plus, the U.S. selling $39 billion in 10-year notes on Thursday. PPI and another round of jobless claims, and we'll look forward to that 30-year debt auction too. And on Friday, going into the weekend, UMich consumer sentiment before we get a bigger read on the US consumer next week. Look out for Tuesday. Just something to note. Look out for retail sales next Tuesday. Before we run off, let's round things up with Annmarie in the City of London. AMH, I have to say, a better morning for the president. Some form of an agreement with China. We won't make it too exciting when it's not. It looks like a lot of work to stand still, but certainly it's better than the other option. And then the data just moments ago. Downside surprise on CPI.
Absolutely, Jonathan. This is just yet another inflation print that came in less than forecast. Neil Dutta hitting the inboxes. I heard you mentioned him earlier. Unemployment is rising before inflation. He says the Fed has TDF. He's saying that's tariff derangement syndrome. Basically, the Fed is too focused on tariffs, and we're not even seeing it in the data just yet. I expect the President of the United States is going to take a similar tone to Neil Dutta shortly, Jonathan, on Truth Social when he wants to talk about those inflation figures. And then all of this, of course, has to do with what's going on with trade. The president talking about these talks that we had in London, more than some 20 hours at the negotiating table between the U.S. and Chinese delegations, and basically talking about the fact that they just want to implement what they agreed upon 4 weeks ago. What's key in the president's truth, though, this morning is that the rare earths will be supplied upfront by China, and he pretty much said that is going to happen immediately. So that is something that is music to the ears of these companies that need these micro metals, and China has complete control, really, on this supply.
Annmarie, appreciate the update. Head to the airport and we'll see you in the studio tomorrow morning. Annmarie Hordern, thank you. Looking forward to catching up with you in person tomorrow morning. From New York, that does it for us. Thank you very much for choosing Bloomberg TV. Investors certainly rewarded for selling the fear and buying the hope. A 20% plus rally on the S&P 500 off the April low, and it continues going into the opening bell. Coming up tomorrow, Francis Donald of RBC, Sarah Hunt of Alpine Saxton Woods, former Fed Vice Chair Richard Clarida, and Lindsay Rosner of Goldman Sachs. From New York City, this was Bloomberg Surveillance.